2022, IAI siap berkarya mengawal perekonomian bangsa ini menuju Indonesia Emas 2045.
Saya sangat mendukung rencana IAI untuk mempercepat program sertifikasi agar para akuntan di negara kita memiliki kreativitas, inovasi, keterampilan, dan memiliki daya saing, dan sekali lagi dalam rangka mendukung pengembangan ekosistem kita yang lebih akuntabel, lebih efisien, goal-oriented, dan inovatif.
Tanggung jawab itu terwujud melalui Chartered Accountant Indonesia sebagai identitas akuntan profesional Indonesia dan telah mendapat pengakuan kualitas secara global. Prakarsa 6.1 berisi 6 langkah aksi dengan satu tujuan strategis untuk memperkuat peran IAI dalam meningkatkan kepercayaan masyarakat terhadap entitas bisnis dan publik dengan menyiapkan akuntan profesional berintegritas siap menghadapi masa depan. IAI melaksanakan tugas dan tanggung jawabnya menyusun standar akuntansi keuangan dan standar profesi, melaksanakan ujian sertifikasi, serta aktivitas keprofesian lain mengacu kepada International Federation of Accountants dan Chartered Accountant Worldwide. IAI for Society dijalankan untuk memberikan manfaat yang semakin besar bagi masyarakat serta untuk mendekatkan profesi kepada publik. Founding Fathers IAI telah menetapkan 2 tujuan pendirian IAI. IAI dibangun untuk mempertinggi mutu pendidikan akuntan dan meningkatkan kualitas pekerjaan akuntan Indonesia. IAI menguasai perubahan, menyiapkan masa depan. Ikatan Akuntan Indonesia, akuntan profesional unggul Indonesia maju. Ikatan Akuntan Indonesia, IAI, telah berkiprah mendukung pembangunan SDM dan transformasi ekonomi Indonesia.
Akuntan memiliki peran penting dalam pembangunan nasional yang berkesinambungan.
Profesi akuntan mendukung upaya peningkatan profesionalisme SDM Indonesia agar bisa optimal berkarya mendukung pembangunan ekonomi yang efisien dan transparan. Melalui Prakarsa 6.1 yang telah ditetapkan sebagai program umum Dewan Pengurus Nasional IAI periode 2018-2022, IAI siap berkarya mengawal perekonomian bangsa ini menuju Indonesia Emas 2045.
Saya sangat mendukung rencana IAI untuk mempercepat program sertifikasi agar para akuntan di negara kita memiliki kreativitas, inovasi, keterampilan, dan memiliki daya saing, dan sekali lagi dalam rangka mendukung pengembangan ekosistem kita yang lebih akuntabel, lebih efisien, goal-oriented, dan inovatif.
Tanggung jawab itu terwujud melalui Chartered Accountant Indonesia sebagai identitas akuntan profesional Indonesia dan telah mendapat pengakuan kualitas secara global. Prakarsa 6.1 berisi 6 langkah aksi dengan satu tujuan strategis untuk memperkuat peran IAI dalam meningkatkan kepercayaan masyarakat terhadap entitas bisnis dan publik dengan menyiapkan akuntan profesional berintegritas siap menghadapi masa depan. IAI melaksanakan tugas dan tanggung jawabnya menyusun standar akuntansi keuangan dan standar profesi, melaksanakan ujian sertifikasi, serta aktivitas keprofesian lain mengacu kepada International Federation of Accountants dan Chartered Accountant Worldwide. IAI for Society dijalankan untuk memberikan manfaat yang semakin besar bagi masyarakat serta untuk mendekatkan profesi kepada publik. Founding Fathers IAI telah menetapkan 2 tujuan pendirian IAI. IAI dibangun untuk mempertinggi mutu pendidikan akuntan dan meningkatkan kualitas pekerjaan akuntan Indonesia. IAI menguasai perubahan, menyiapkan masa depan. Ikatan Akuntan Indonesia, akuntan profesional unggul, Indonesia maju. Ikatan Akuntan Indonesia, IAI, telah berkiprah mendukung pembangunan SDM dan transformasi ekonomi Indonesia.
Akuntan memiliki peran
Chairman of Institute of Indonesia Chartered Accountant Tax Accountant Compartment and Director of International Taxation DGT Indonesia, Professor John Hutagaul. Managing Director Bureau van Dijk, a Moody's Analytic Company, Mr. Kisodial. Member of IAI National Council, Council Member of IAI Tax Accountants Compartment, our colleague from ASEAN Federation of Accountants, the honorable speakers and moderators, and all the distinguished guests, participants, ladies and gentlemen. Good afternoon and welcome to the second day of our virtual International Tax Conference 2020 with the theme Current Updates International Taxation Development. This is the seventh collaboration between IAI, KAPJ, and Bureau van Dijk, a Moody's Analytic Company. And this year we will be deliver this event in virtual. To deliver the opening speech for today, we would like to kindly invite the Honorable Mr. Kisodial, Managing Director, Bureau van Dijk, a Moody's Analytics Company. So, Mr. Dial, the floor is yours.
Thank you very much, Monica. Okay, good afternoon, ladies and gentlemen. Thank you all for being here with us today. It's a great pleasure to kickstart the second day of the International Tax Conference 2020, and a warm welcome to all of those that have joined us for this conference for a number of years now, and all of those that are joining us for the first time. My name is Kisodial. I am the Managing Director of Bureau van Dijk for the APAC region. And we, Bureau van Dijk, in collaboration with the Indonesian Institute of Accountants, IAI, have been organizing this event for the past 7 years in Jakarta. This is the first time we're doing it online, so it's the second day. I hope everything goes well, leveraging these new technologies. So fingers crossed, and we'll all in this together. Before moving forward, I just wanted to thank those without whose support this event would not have been possible. So Professor Madriasmo, President of Institute of Indonesia Chartered Accountants and Vice Minister of Finance, Republic of Indonesia. Mr. Suryo Utomo, Director General of Taxes, Ministry of Finance, Republic of Indonesia. Professor John Hutagaul, Chairman of Indonesia Institute of Accountants, IAI, and Director of International Taxation. Mr. Peru Pambudi, Director General of Customs and Excise, Ministry of Finance, Republic of Indonesia. And as well, thank you very much in advance for all the speakers, moderators in our panel discussions and presentations today. So 2020, a very funny year. I don't think we can talk about 2020 without bringing up COVID-19. So this COVID-19 pandemic has caused a major shock to the world. So its implications are far-reaching. It affected households, private sector businesses, public sector organizations, public offices, and affected all these institutions and families in an unprecedented way. All corners of the world have been affected. If we look like where the pandemic is spread today, Europe, Africa, America, Asia Pacific, Latin America. So individuals from all social and economic backgrounds, rich people, poor people, famous people, the non-so-famous people, celebrities, and even high-ranking public officials have been victims to this disease. The Prime Minister of the UK has had COVID in the past. The Prime Minister of Russia has had COVID. The President of Brazil had COVID. Now we have the President of the United States and his wife recovering from this infection. And even in Indonesia, high-ranking officials have had the disease. At least 3 ministers have been infected: the Minister of Transport, the Minister of Fisheries, and the latest victim, the Minister of Religious Affairs. So I believe all of them are recovered and doing well. So that's very good news. But in order to deal with this crisis, governments worldwide are facing a dilemma. On one hand, they need to protect their citizens and the public health systems in their countries. But on the other hand as well, they need to keep the economy going and, avoid even a further crisis and economic depression. So as we know, the social restrictions in place to slow down and limit the spread of this pandemic affect economic activity by reducing it. And we know that reduced economic activity translates into lower tax revenue for the government. And at the same time, the governments have to support their economies through stimulus, social benefits packages to keep the wheels of the economies going. So what we're finding is that the budget deficits of governments and the debt of the governments is going up because they're spending a lot of money to combat this pandemic and support their economies, and tax revenue collections are down because GDP is contracting. In addition to the widening public budget deficits, the combination of severe GDP contractions, higher unemployment, record number of businesses closing and failing, quickly rushed relief stimulus programs create this environment where criminal activity, financial crime, and fraud tend to go up. The bad guys tend to thrive during crisis and chaos because public officials are focusing on other priorities like public health and rescuing their economies. So against this dreadful backdrop, many government agencies are turning to technology and business intelligence to boost their economic activity, to reform their economies, save jobs, and also combat and prevent fraud and financial crime. We at Bureau van Dijk, we offer this technology and business intelligence that many public institutions in the world use in the areas of law enforcement, intelligence, and national security, government sourcing and procurement, economic research, and transfer pricing and taxation. We've been helping these government institutions worldwide for a number of years, and even more so now during this crisis in terms of preventing and mitigating risk, perform investigative work, research, improve efficiencies, improve effectiveness, and reduce tax collection gaps. So this vertical of tax is very important and relevant for today's agenda. And currently, more than 50 tax authorities in the world use Orbis. Orbis is our flagship business intelligence database with information on more than 370 million companies. Orbis shows what these companies do, how they are performing, who is the people that runs them, and who is the people that owns them. It also has a lot of information on corporate structures and ownership, and have information on financial data, legal entity details, news, and much more. By having such a comprehensive company information available, these tax professionals and tax authorities use our data and business intelligence to identify companies to establish reliable arm's length principle. They use our capabilities and solutions to conduct BEPS risk assessment analysis. They use our solutions to streamline and transfer pricing, benchmarking, and documentation process. And also they use our solutions to visualize corporate structures and the linkages between companies and individuals. So individuals, we're talking about shareholders, directors, and managers, in order to detect and investigate potential tax evasion and tax avoidance practices within these networks of individuals and companies. So all these insights, information, and business intelligence we provide are very relevant to today's agenda. So in today's agenda and this afternoon, we will start with a keynote speech by Mr. Pascal Saint-Amand, Director of the Center of Tax Policy and Administration at the OECD. Then we will have two panel discussions, one discussing the current update of transfer pricing development and dispute settlement, the other one discussing tax treaty and multilateral instrument, MLI. And in between, we will have a presentation by my colleague, Mr. Makbul Lalji, focusing on the use of data to limit tax avoidance and tax evasion. Mr. Lalji comes with many years and decades even of experience in performing such tax investigations with the UK Tax Authority, the HMRC. Then to close this event, we'll have some closing remarks by Professor John Hutagalung, Chairman of the Institute of Indonesian Chartered Accountants. So essentially, this is what we have planned for today. I truly hope that you find the presentations and discussions informative, insightful, and useful. I now would like to hand over to Mr. Pascal Saint-Amand for his opening keynote speech. But before doing so, I just wanted to give a word to all the professionals and organizers from both the Indonesian Institute of Chartered Tax Accountants and all my colleagues in Bureau van Dijk, who put a lot of work and good work in order to make this event happen and that it runs flawlessly. So thank you very much, everyone, for preparing this and allowing us to have these interesting discussions. And now, without any further delay, I'll hand over to Mr. Pascal Saint-Amand.
Okay, thank you, Mr. Kisodial, for a warm welcome. But ladies and gentlemen, we're still waiting Mr. Pascal Amand to join this webinar. Thus, we will start our panel discussion one. So the discussion today, the topic is current update of transfer pricing development and dispute settlement. For the panelists, we will have Ms. Dwi Astuti, Deputy Director of International Taxation for Dispute Prevention and Settlement, Directorate of International Taxation, DGT Indonesia. Also, we will have Mr. Dani Septriadi, Senior Partner of DDTC, Mr. Permana Adi Saputra, Vice Managing Partner of PBTaxan. The moderator is Ms. Christine Chen, the tax expert, Universitas Indonesia. So welcome to the panelists and the host. But before we start the discussion, let me read a brief CV of Ms. Christine Chen. Kristen is a lecturer at the Department of Accounting, Faculty of Economic and Business, Universitas Indonesia. She received master's degree in international taxation from University of Sydney and Bachelor of Accounting from Faculty of Economics, Universitas Indonesia. So now we will let Ms. Christine Chen to host the session.
Okay, thank you, Monique. Good afternoon, ladies and gentlemen. The Honorable Professor John Hutagalung, the Chairman of IAI Tax Accountant Department, and also Mr. Kisodial, Managing Director of Bureau van Dijk, our distinguished speakers, and all the participants of today's webinar. How are you today? I wish you all be happy and healthy. It is an honor for me to become the moderator of this panel discussion. It is the session 3 of Virtual International Tax Conference 2020. As we know that the transfer pricing always been a sexy topic to be discussed in the international tax context. And also, we also know that the transfer pricing is not an exact science. Therefore, in practice, there might be disputes in its implementation. In addition, the COVID-19 pandemic creates significant changes in the global economic situation, which might impact significantly to MNEs and also the domestic group of companies. Therefore, this condition might create a major transfer pricing issue in the future. So, in relation to the above issues, today we will discuss a very interesting topic with regards to the transfer pricing. It is about the current update of transfer pricing development and dispute settlement, that will be delivered by our prominent speakers. Our first speaker is Ibu Dwi Astuti from Director General of Taxation. But firstly, I would like to read her curriculum vitae. Ibu Dwi Astuti, her current position is Deputy Director of International Taxation for Dispute Prevention and Settlement, Directorate of International Taxation, DGT Indonesia. She earned Master in Public Policy and Taxation from Yokohama National University. And before her current position, she was the head of Primary Tax Service Office Cempaka Putih and Tanah Abang II. And also, she became the head of Sub-Directorate of International Taxation and Cooperation Agreement. Without further ado, I would like to invite Ibu Dwi Astuti, to share with us her presentation. So Ibu Dwi, the floor is yours.
Thank you. What a nice introduction, Ms. Christine. Thank you for time. This is a pleasure for me to have also another session in the IAI event, and then also with Bureau van Dijk. And it is not the first. I think last year I also became a speaker, a panelist in this event. I would like also to say thank you to my boss actually, and also is the chairman of the Institute of Indonesian Chartered Accountants of Tax Accountant Compartment, Pak John Hutagaul. Good afternoon, Pak. Allow me to present the current update of transfer pricing development and dispute settlements. So I would like also to say hi to Mr. Kiso Dial as Managing Director of Bureau van Dijk, and also all the participants who already attended this virtual meeting today. So now I would like to invite the committee to maybe to share the screen. I already delivered to Ms. Fauzia. It is also interesting what already said by Ms. Christine, that nowadays in this very difficult situation regarding the COVID-19, it is also somehow may invite what I can say, the new development or the new thought regarding transfer pricing. Indeed, it is. There is many questions came to us asking whether the Directorate General of Taxes will make certain or special regulation regarding transfer pricing because of this COVID. Maybe it will be answered later on by my presentation. Now let's just start to the first presentation. Please, the next. In this case, I just would like to also giving the update regarding the organizational structure. Maybe before this, please, for the dispute settlement and the dispute settlement and prevention. As now in our organization, in this case in DGT, we have dedicated unit, you may say. That solely dealing with the transfer pricing in order to prevent or to also to settle the dispute of the transfer pricing. We have 4 sections in this case, and then it is dealing the cases for the first section, dealing the cases from Asia Pacific, and then all Pacific countries, or also New Zealand, something like that. And then the second section deal with Japan, America. The third section, it will deal with South Korea, China, Hong Kong, and then Macau, China, and then also for European and African countries. Maybe you wonder why we divided into so many sections, in this case 4 sections, dealing with the dispute settlement and prevention. In this case, we want to giving the best effort or the best services to the taxpayer, that we are acting professionally. That's why we divided into 4 sections, so everybody could focus in their cases. So in this case, in terms of the time, in terms of the quality, that's why we consider that it is divided into 4 sections, and each section is really specialized into certain area or certain regional. This is this is also follows the recommendation from BEPS, especially the minimum standard of BEPS action plan number 14, that it is recommend we have to making dispute resolution and mechanism more effective. That's why in order to respond that action plan, we make the dispute settlement and also dispute prevention into regional or into regional or certain jurisdiction. So, and what is the role and the function of the international taxation dispute prevention and settlement? Basically, we are in charge of administer the materials for the view formulation and also the policy regulation, the policy, the regulation, the coordination with other directorate, and also responsible for the implementation of the policies and regulation in order to prevent the dispute or also to settle the international transfer pricing disputes. So it is, I mean, it is common and then also well known, as many countries have this specialty in order to taking care of the transfer pricing. But not to mention also there is many jurisdictions, they don't have any special organizational structure or special unit to deal with the transfer pricing. So in case of Indonesia, we want to make, as I said before, we want to make the mechanism more effective. So that's why we have a special units with the special roles. In terms of the regulation and the policy, we are also responsible for to make or to disseminate all the regulation, and there is also the implementation the arm's length principle. In this case, and I think most of the participants are quite familiar with so-called advanced pricing agreement and also mutual pricing agreement procedures. So in this case, we are responsible for having those two mechanisms is really running well for MAP and also for the APA. As prevention of dispute, in this case, advanced pricing agreement, we just make the regulation. It is just now actually the Minister Regulation number 22, 2020, just like last July, we revealed that. And it is, we have a complete regulation regarding advanced pricing agreements, including the arm's length principle regulation in there. So, so with this regulation, it is make our dispute prevention even more effective and more certain for the taxpayers. In terms of dispute settlement, we also have the MOF regulation number 49, 2019. It is revealed on April 2019. In this case, we also have a complete regulation in order to make our MAB regulation more effective and then implemented in the field. In this case, also MOF regulation number 49 gives sufficient certainty. In this case, I may say the certainty for the taxpayer in order to have a dispute settlement mechanism. Next, please. So as I mentioned before, there is two mechanisms in order to make transfer pricing dispute resolution. There are in the domestic one, and then also in this case, objection and appeal, and then also international. As I mentioned before, for the dispute prevention using the APA, we also have now is already being revealed the regulation of DGT number 14, 2020. In this case, it is also like make even more clarity or more clarification. Yes.
Excuse me, Pascal is already joined with us, so maybe we will give Pascal the yeah. Thank you, Wewe.
Yes.
I will continue
Yes.
later with you. Okay. Okay, to Mr. Pascal Saint Armand, we would like to invite you to have a presentation to your keynote speaker today. Thank you.
Thank you so much. I feel so sorry that Gustati was interrupted because I was listening in carefully and I apologize.
No worries, Pascal, no worries.
Okay, no, really apologies. I joined late because I was on the call earlier today. It's early in France, but I started early to brief the ambassadors of the OECD on the outcome of the work on digital, and they had many questions, so I was stuck in that call. So really apologies for the large crowds which is attending this conference. I can see almost 500 participants. It's really impressive, and congratulations and thanks a lot for the invitation. I see Dak Hutagol, John, our good friend, on the screen. So good afternoon to you all, and thanks a lot for the invitation. And again, apologies for having interrupted the very good presentation which was going on. Listen, as you've invited me to do an update on where we are on the digital work and more generally the work of the OECD, I take a few minutes and will be happy to take a couple of questions if need be. You know the OECD, you know the work we're doing, and you know that the OECD in tax matters is not a limited country to 37 members, but rather a pretty large body with 137 members on an equal footing for the work on BEPS implementation, Indonesia being one of them, and also for exchange of information, the Global Forum on Transparency with today 161 members, and of course Indonesia is one of them. Indonesia is an extremely important country in that landscape, one because of, I mean, the size of your country and the important, the economic importance of the country, but also because you are a member of the G20, so you contribute to shaping the international tax rules, and that's why we are so glad to work very closely with you. We have one person from my team, the Center for Tax Policy and Administration, based in Jakarta under our back, working very closely with John and his team. And we strongly believe in all the work we can do together. The international tax agenda for the past 10 years has been quite frantic, changing very fast. You may remember that until 2008, international tax was very much limited to a few bilateral tax treaties, through bilateral instruments with commentaries provided by the OECD Model Tax Convention and by the transfer pricing guidelines. So we were all within one box and working within that box. The main questions at that time being, what kind of withholding tax could you get from a partner, and so. Things have changed dramatically since 2008, since the global financial crisis. The world realized that if we wanted to address the challenges of globalization, we had to do more in the field of tax cooperation. And as a result, we have seen a change of paradigm in international tax with, in the first phase, I would say from 2009 to 2012, the recognition that tax cooperation was absolutely key and that we had to put an end to the time of bank secrecy. That's something very sensitive and important for Indonesia. I don't know how many bank accounts you have received from Singapore or from Hong Kong, but that probably is above hundreds of thousands, if not millions. So something which was key to restore the sovereignty of countries like Indonesia, which was to organize tax cooperation. And we have built the Global Forum for this, and we have built multilateral instrument for this. There is a multilateral convention on mutual assistance that you have signed very early in 2011 at the G20 summit in Cannes, and now we have more than 9,000 bilateral exchanges possible through this multilateral instrument. The second phase of establishing a new paradigm for international tax was with the launch of the BEPS project for base erosion and profit shifting back in 2012-2013, and the delivery of the 15 actions of the action plan at that time. We changed a number of rules. We introduced new rules for better tax coordination between countries, for the transparency of tax rulings, for putting an end to hybrid mismatches, for trying to fix the definition of the permanent establishment and making transfer pricing rules more relevant, but also for introducing more transparency, in particular the country-by-country reporting. And we are now 5 years down the line of the BEPS implementation, but in BEPS, there was one action on which we did not deliver in 2015 and which has become the focus of the international community, but also of political leaders everywhere in the world, in Indonesia as well. We regularly exchange with Minister Sri Mulyani on the topic of addressing the tax challenges of the digitalization of the economy. In 2017, the G20 gave us a mandate to try to solve the issue by the end of 2020. And that's what we've spent the last 3 years on, trying to solve this issue. And it's not an easy issue. So we tried to develop a solution in 2 pillars. A pillar 1, which has advanced, and we'll come back to that in a second. A pillar 1 including a new nexus, saying that a company should be taxable in a country even if it does not have a permanent establishment, where it has a sustained engagement in the market in that jurisdiction. So that's the baseline of the new nexus. It sounds like where you have a certain degree of engagement in the market and the mere sales in the market above a certain level should be enough to consider that there is a new nexus. That's the spirit of the work which has been done so far. If you have a new taxing right because there is a new nexus, then the question is how much profit would you allocate to that jurisdiction? And that's the profit allocation issue, which we have been dealing with as well. And there were many questions on who should be in the scope of this new taxing right. And there was a divide between countries. And I would say there still is a divide. We haven't been able to sort this out. A divide between those thinking this is only for digital companies, and therefore the new taxing right should apply only to some form of digital companies, the ones with the platforms, the one with the advertisement business model, where there is an interaction with the users, where some data is taken in exchange of a free service, which will be monetized very often in a third country, like Singapore in your region. We want to tax this element linked to the users. So that's one approach. But another approach, which has been approached by the United States in particular, who are key because most of the tech giants are American companies, the Americans said, no, we think that it's time to move to a broader approach, which is consistent with the conclusions of the Action 1 report of the BEPS Action Plan, which concluded that there is no such thing as the digital economy, but we should instead talk about the digitalization of the economy. And therefore, the new taxing right should not be limited to some business models, but to all the cases where there is an interaction with the market jurisdiction. And all that was synthesized by the OECD Secretariat in October last year, it's just 1 year now, in what we have called the unified approach, which is a proposal to have a scope which would include digital, automated digital services on the one hand, and on the other hand, the consumer-facing businesses, where there is a personal interaction with the end consumer of the company. So no agreement on the scope, which is why we are not going, and maybe that's the scoop that I share with you, but I don't expect the G20 to come to an agreement on Pillar 1 next week, largely because of this disagreement on the scope, which has prevented us from making decisive progress on the remaining questions, even though we have built an architecture for Pillar 1. So there is no agreement on who should be in scope, but I think there is agreement on what should the architecture of this new taxing right look like. And in particular, there is agreement on the fact that it's only the excess return of the companies which would be in scope, which would be considered as a pot of profit to be reallocated based on a formula. So you can see here a shift away from the arm's length principle and the pure entity by entity approach. Instead, we would have a reallocation of part of the residual profit determined as in excess of a normal return, probably 10% of the normal return, and that a percentage of that would be allocated through a formula based on sales to the countries of where the consumers are located. There is, together with that, very significant work on how you compute the tax base in a way which would be consistent across the countries, and also rules for business line segmentations in case you have businesses which are partly in scope and partly not in scope. So the whole Pillar 1, in spite of lack of agreement on the scope, which is quite decisive, but the whole Pillar 1 has been developed. I have to add that the countries which would agree to give up part of the taxing rights on the excess return on the rent, if we want to use an economic term of some companies, the deal would include more tax certainty, which is a challenge for many countries, in particular developing countries or emerging economies, including Indonesia, because the US or the Europeans say, okay, we are ready to go beyond digital. We are ready to give up part of our taxing rights and allocate part of the rent to the market jurisdictions. But in exchange for that, we would like to have real tax certainty and mechanisms where countries not only endeavor to eliminate double taxation as per the existing article on tax treaties, but would be compelled to eliminate double taxation and therefore provide tax certainty. So that's the package under Pillar 1, which is not going to be agreed now, but which is sketched out in a blueprint that we are going to present to the G20 on Monday next. So you're really the first ones to hear about that, as this will go to the full inclusive framework tomorrow and on Friday, if we need 2 days. John will be the delegate with his team to the inclusive framework. It's a virtual meeting, unfortunately, for the reasons we all know. And the inclusive framework, I think, will recognize that this blueprint is not agreed as such, because there are still political disagreement on some design features, but that it's good enough to be considered as a document for public consultation. And we will do a public consultation until year-end on Pillar 1. And the reason why we are doing the public consultation is that we have not yet publicly consulted on this. So we need business input, and you're welcome to input in that work. on all the aspects, on the scope, on the design features, on the business line segmentation, on the computation of the profit, on the tax base, on the tax certainty. You will see that there are 10 chapters on Pillar 1. There are 450 pages of technical work which has been achieved. So material, rich material you can comment on. And the business consultation, also the public consultation, is also a way for us to wait and see what's going to happen in the US, because you all are aware that there is an election in the US in 3 weeks' time, and we need to see which administration will have to deal with, and that may unlock the disagreement which has been reached, which has not been solved so far. I indicated there were 2 pillars because there is another dimension which follows the US tax reform, which was introduced in 2017 in the US. The US tax reform providing for a slash in the rate from 35 to 21%, but also broadening the tax base. And in broadening the tax base, the US introduced the provision they call GILTI for global intangible low tax income. GILTI being a global minimum tax, or being a minimum tax for the US, and many countries want to duplicate this at the global level. So the Pillar 2 is about what we call the GLOBE proposal, which is for a global minimum tax that countries would put in place. Here also, you have a couple of hundreds of pages of technical work which has been advanced. There is no agreement yet because many countries think that Pillar 1 and Pillar 2 are linked, and they don't see why they would agree on the global minimum tax if we haven't solved the distributional aspects of the digital tax first. The global minimum tax is, you will see, quite well detailed in the blueprint. There are design features which are well advanced on the blending. No decision is taken, but you will see that it's a jurisdictional blending which is favored by the promoters of this solution. There is a carve-out. What is exempt, it's slightly more generous than the carve-out provided by GILTI, which is only 10% of the fixed asset, while there will be an element related to the payroll, to the wages, to the salaries, so that substance, if you have many people in the country and there would be this taken into consideration, it wouldn't be taken by the global minimum tax. You have the rule order, it would be income inclusion first and then the under-tax payment rule, but countries have not yet fully agreed, and developing countries and emerging economies say, okay, that's not the rule order we favor, but because of that, we should have a subject to tax rule, which would restore our taxing rights first before the income inclusion rule would be implemented. So you have all these elements plus the rate, which remains to be decided, which would be the cherry on the top of the pie of the cake. So Pillar 2 will not be agreed, but equally to Pillar 1, it will be released for public consultation, and we'll see what happens by year end. Of course, the lack of delivery or the failure to deliver on time may trigger unilateral measures. Indonesia mentioned that they may take unilateral measures, but on the other hand, we have to take into account that there will probably be a new US administration, and maybe countries will be willing to give a chance to the new US administration to position itself on this topic before moving unilaterally. What is at stake, however, at the end of the day, is either we find an agreement on both pillars, or on one pillar or the other pillar at the OECD inclusive framework, and there we will avoid having unilateral measures, or we don't find a solution next year. I think we need to extend the deadline because of the US election, and in that case, we will have to wait and see whether countries move unilaterally, which may trigger trade wars and so. So what is at stake here goes beyond tax, and that's why it's extremely important. And that's why we're extremely happy to work closely with Indonesia on these topics. All that, as I said, will go public on Monday, so stay tuned, and you will see all these material as tax geeks, I suppose you are, you will be, I think, quite interested in the package. Thank you.
Okay, thank you so much, Mr. Pascal, for your interesting keynote speech. And now there will be a couple questions for you. Maybe EAI will share. Okay, so this is the questions for you, Mr. Pascal. The first one, could you please share with us the OECD work to provide a guideline to the tax authorities dealing with COVID-19 pandemic? And the second question is, what is the biggest challenge for OECD to deal with many countries with different culture and government system in promoting the tax guideline to all countries? Yeah.
Thank you so much. Very, very good question, Christine. So the first question is very important. We have done a lot of work in addition to the work on digital to help countries address the pandemic from a tax perspective. I would say we've done 4 main contributions there. The first one has been and still is to collect all the measures, the tax measures taken by governments across the world, put them in the database. So we have all the measures taken to address the crisis, either on the peak phase or at the recovery phase. And we know that now we have a mixture of peak and recovery at the same time because this virus issue is lasting quite long. So you have a database of all the measures taken. And that's very important for governments because instead of reinventing the wheel, they can go to the database and see what countries have done. And you have, I don't have the latest number because it's fed on a daily basis, but probably more than 1,000 measures which are listed there. So that's the first thing we have done. 2, we have, I mean, it goes with that first point. We have done a report in April to give recommendations to countries, what the best practices are. And our recommendation in a nutshell is countries should do whatever it costs to help at the peak of the disease. So when you have a lockdown of the country, confinement, as we call it in French, you need to support the economy. You need to support the workers. You need to keep the production capacities intact. And that's where whatever it costs must be done. On the second phase, when people are back to work, where the economy slightly resumes, you need to be more targeted and you need to support the most vulnerable sectors. Now, it's a generic recommendation. We fully recognize that where the informal economy is big, the issue is different. And Indonesia is a country where you still have a significant chunk of the economy which is informal. But still, that's the philosophy. The last key recommendation is do not rush to fiscal consolidation. Don't try to increase the taxes too early or you will kill any chance of recovery. And the sustainability of the debt, which is resulting from the pandemic, will be determined by the growth of the country more than the taxes immediately collected. So if you try to consolidate too quickly, you may kill the growth, which is what will make the debt sustainable, because given the low interest rate, including for emerging economies, even though you are more vulnerable and you're more exposed to a debt crisis, but still the sustainability will be judged on the growth, and the growth needs to be supported by tax cuts more than by tax increases. So that's the first block of things we've done. The second block is we have talked to tax administrations, and tax administrations provided for tax administrations guidelines on how to keep the continuity of the service to the taxpayers in spite of the pandemic. So there is a lot of very good work by tax administrations there. The third block of work on the COVID has been on tax treaties. We immediately clarified, it was in April, I think, that for the computation of timelines on the residency or for cross-border workers, and so countries should be flexible. and there should be some form of neutrality on taxpayers. We may need to revisit this as the pandemic lasts, because it's one thing to say, well, you don't have a residence if you spend an extra 40 or 80 days in a country because you're locked down there and that's not your normal country of residence. It's true that if it lasts 1 year, we may need to revisit this, but that's an area where we have provided guidance to the tax policy makers and tax treaty implementation. And finally, the last block is work in construction. We are trying to develop guidelines on transfer pricing at the time of COVID. What are the implications of the COVID crisis on transfer pricing? We are in the final stage of developing a recommendation, which we hope we can publish before year-end, which may help the accountants, the tax directors in companies to fine-tune their financial statement by year-end. So that's the whole work which has been done. As regards to the second question, it's a very, very good question. The reason I was late in the call is that this morning I had to address the group of the ambassadors of the small countries of the OECD. They've gathered together to be regularly briefed because they're not in the G20 like you, and the small countries, they're nervous and they want to have good information so that the information doesn't stay only with the large countries like the G20 countries like Indonesia. So it shows the diversity. We have large countries like you, we have very small countries. We have investment hubs like Singapore, which is a member of the inclusive framework, or Luxembourg, or the Netherlands, or Switzerland. And we have high tax countries like France, like Germany, like the Nordic countries. We have developed countries, European countries, the US. We have developing countries. We have many African countries. We have Latin American countries. In the membership, we have a majority of developing countries. We have emerging economies which are diverse. You're not China, you're not Brazil, you're not South Africa, but you are all the emerging economies which are not OECD countries, but which are members of the G20. So you can see that the diversity is extremely large. How do we cope with that diversity? And in English, I think one would say, how do we herd the cats? Because it sometimes looks like a fight between cats, each country fighting for its own interest. It's extremely difficult. It's very challenging. And we need a good political dynamic to get all these delegates from the different countries to try to seek compromise rather than reflect their diversity. Diversity is great, needs to be respected, but at some point we need convergent views, we need common rules. And that's how we work in the Secretariat, to try to get countries to move without being brutal, without obliging them to do stuff which would be contrary to their legal system or to their constitution, but still converging. And it's so important that they converge, because if they do not converge, then we'll be back to unilateral actions. Countries are sovereign, they can do it, but if they do it, they may face trade retaliations because other countries are sovereign too, and they can defend themselves. So you have the choice between harmony, which means that you give up stuff to converge, or disharmony. And disharmony is about I do what I want, but others do what they want too, including retaliating on me. And that's the trade-off. What do you want? And it's not always easy. And the reason why we haven't been able to deliver on the digital for this year, but we're confident that we can deliver next year, is because the political dynamic was not strong enough for us to herd the cats and to get countries together. This was largely due to the US administration, which didn't really decide on whether they wanted a broad scope for Pillar 1 or a small scope. I developed on that earlier. So that's what we do. It's difficult, but it's fascinating to interact with that many cultures, that many differences. But all these people have in common to speak the same language, which is not English, even though the negotiation is in English, but which is tax. So we all speak tax. That's a way to get united.
Okay, thank you, Mr. Pascal Saint-Amand, for delivering the keynote speech for the International Tax Conference 2020. Now we would like to invite Mr. Pascal Saint-Amand, Bapak Profesor John Hutagaol, Mr. Kisodial, Bapak Edward Tanujaya, to do the group picture. So could you please turn on your video so we can have a screenshot? Ibu Christine is also ready. Ibu Dwi Astuti. Okay, Bapak Jan Hutagaol, are you ready? Okay. Now all smile.
Yep.
Okay. Thank you. Thank you.
Pascal, thank you very much for
My
your
pleasure.
Very much, Mr. Pascal.
presentation, and thank you.
Thank you, Pascal.
See you tomorrow.
I see you tomorrow.
Okay. Now we will continue our panel discussion
Pak.
one.
Ya, Pak Sahli.
So Ibu Christine, could you please continue to host the session?
Yeah.
Thank you, Mbak Monica. I will go back to Ibu Ewi. Ibu Ewi, the time is yours to continue your presentation. Please, Bu Ewi.
Ya. Pak Sahli, mohon izin juga terkait dengan batu bara dan mineral.
Bu Ewi still mute, Bu Ewi?
Yes, okay.
Okay. Yes, please continue, Ibu. Thank you.
Okay, thank you. I mean, please just go to the next page, and I think I'm done with this. I already explained this before. Now, I think the time is not so much left for all of us, so that's why I just want to make it quick. So I think maybe if you still have some questions, we can have it in the Q and answer sessions. So now I would like to update on the APA features in Indonesia. So maybe if it is also already familiar with you that Indonesia also have a feature for APA, unilateral APA and also bilateral APA. And in this case, if we refer to the OECD transfer pricing guidelines, bilateral APA, it's called MAP-APS, they call it, but we call it a bilateral APA. And then I think this is the new regulation in the MOF regulation number 22. Now there are several key deadlines that you have to put attention if we want to submit the APA. The form application must be submitted during the period of 12 months to 6 months prior to the APA period started. So in that case, you have please put your attention that it should be submitted a year or half year prior to the period of the APA. And then the document supported for the submission, it must be provided within 2 months after the DGT issues the written acknowledgement to the taxpayer that requests the APA. So in this case, also there is a certain requirement in order to make our APA processes is more flourish, because now we have like 12 months period for the APA, and then we should follow this regulation. So in that case, the APA submission should be finished within 12 months for the unilateral, but for the bilateral APA, it could be until 24 months, since the bilateral APA, it will be follows the MAP regulation. And then what just again in the PMK or MOF regulation number 22 is the cover periods. Now your cover periods is like one period is 5 years. And then with the rollback, also it could be 5 years as long as the tax year is not elapsed or not issued the assessment yet for those years that will be in the rollback period. So for example, if you have like 5 years covered periods ahead and then rollback, it could be also 5 years. So in this case, you have advanced pricing agreement in total become 10 years. And then it could be also renew for one more period of APA. So if, for example, the taxpayer already submitted the APA, feels satisfied, and then again want to renew the APA, and then it could be again for 5 years. So in total, basically, if there is no certain condition occurs, the APA it will be covered like 15 years, as long as the requirement is fulfilled. 5 years for one period, and then it is possible roll back for 5 years, and then it could be renewed again for another 5 years, for another one period of APA. Next, please. And then again, in order to submit the APA, so there is several key features you have to put attention regarding the formal requirement. So the first formal requirement is that the submission of the applicant has submitted. In this case, the taxpayer has submitted the annual corporate income tax return for past 3 taxable years prior to the taxable year of the submission of the APA application. So in that case, everybody who wants to submit the APA, it must already submit the tax return for 3 years consecutively before the APA period. So if it is, it's less than 3 years, so it means the formal requirement is not being fulfilled. And then the second formal requirement is the applicant has fulfilled the obligation to prepare and conduct the TP documentation for past 3 years taxable years also. It is also the same with the first criteria, submit the tax return along with the TP documentation. Again, it is the same period for the 3 years. The next formal requirements is that the applicant is not being investigated or being charged for the tax crime, and it is a must. If it is, during the negotiation, and then the applicant charged for the tax crime, and then we will stop for sure the negotiation. The next requirement is that the affiliated transaction and the affiliated party at issue have been reported in the applicant's annual corporate income tax return for the past 3 taxable years prior to the taxable year of the submission APA application. In implementation, in the simple way, it is that the affiliated transaction and then the affiliated party, it is already being reported in the tax return for taxable year consecutively in the tax return. So if you fail to report this transaction or the affiliated party in the tax return, in one of the tax return prior to APA submission, in this case, it is also considered not fulfill the formal requirements. So please put the attention, the tax return submission, the TP documentation, and then also the affiliated transaction and the affiliated parties should be also reported along with these 2 previously I mentioned. In this case, in the tax return, you have to report the TP documentation and also the transaction and the affiliated party. 3 years. The last is the APA proposal complies with the arm's length principle and does not cause the operating profit of the applicants become smaller than the operating profit in the annual corporate income tax return for the past 3 taxable years. Again, it is prior to the submission of the application. So this is the reasons behind why we put these requirements. In this case, we don't want you that APA application is like become the formalized that you want the taxpayer or the applicants make the pricing policy that lower than it should be. or in that case, in this case, that may lead to the tax avoidance or tax evasion even further. So in that case, again, I would like to highlight this case that the operating profit it is not it is prohibited that the operating profit lower or smaller than operating profit that is already being reported for the past 3 taxable years prior to taxable the subdivision. So in this case, you have to aware about this. Again, I would repeat because it is very important because most of the applicants usually fail to fulfill this requirement. First, regarding the tax return, the TP documentation, the TP documentation, and then it is also reported the affiliated transaction, and then the affiliated party in the tax return, and then last is regarding the operating profit. It cannot be lower than is already being reported for the past 3 years before the APA submission. That's in short. Next, please. There is no filling a fee for this APA. Maybe you also noticed that in some countries there is a fee for in filing the APA. In Indonesia, it's not that case. And then please again put some attention for the collateral issues that I would like to explain to you in order to this APA could be processed. In this case, DGT could be disagree with the taxpayer proposal if one of the conditions occurs. So this collateral issues become very critical. So again, this is very important to know by all of the you here. DGT could be disagree with the proposal if the affiliated transaction is not based on the economic motives. Maybe there is different motive in that case. And then if the economic substance of the affiliated transaction is very different from its formal form. For example, there is a certain form which should be fulfilled in order to make the APA submission. So what we are trying to say is that what is the you stated in the form, and then what is in the reality, if it is very different, and then in this case, we will always say no to this kind of proposal. And then the next is that one of the purpose of the affiliated transaction is to minimize tax burdens. And as I mentioned before, the APA is not supposed to be to give legalized transaction that allow taxpayer to minimize the tax burden. As long as the condition is the same, the business process is the same, or all the circumstances is the same, it is understandable if there is the tax burden become less, as long as all the condition is the same. Next is that the information and all the evidence submitted by the taxpayer is incorrect or not is in accordance with the actual condition. This is nothing to say more regarding this. If it is incorrect at any time, at any stage in Indonesia, or DGT will say a no to the proposal. Next is the taxpayer does not respond to request for the information by the DGT within 14 days after the date of the written request. Why we put this as a very important steps or very important procedures? As I mentioned earlier, the time for the APA processes is like for the APA process is 12 months or 1 year. So in this case, time is not luxurious for us. So that's why we are very strict in the documentation and everything actually in terms of the procedures. because I think it is very logical if the applicant or the taxpayer in this case want to submit the APA, and I think the taxpayer is already being prepared for any documentation may need it in the processes. So in that case, within the 14 days is more than enough for the taxpayer to provide any documentation needed along with the negotiation. And then last is is the tax year in APA or rollback that has been issued the tax assessment letter. So as I mentioned earlier, if it is already being assessed for the cover period or the rollback period, it cannot be again become a subject or become a year for APA application. Next, please. So in terms of the implementation, if it is already agreed by negotiation for the APA, so in this case, it a must for the applicant or for the taxpayer to implement the AMLAN's process already agreed. It is a must to apply what is the already agreed or the arm's length price is already discussed, is already negotiated in the agreement. And in this case, I mean, we are really appreciated for this terminology actually, because there is also the case we already being, we already have negotiation, we already agreed on a certain provision in the negotiation, and then when it is want to be obligated, the taxpayer said no or withdraw the agreement, and it is really it's not. It's not a favor for us. It's not a favorable condition for us. So that's why once the agreement is achieved, the agreement is achieved, when the negotiation is concluded, and then the taxpayer must apply what is already being agreed, in this case, the arm's length price of each affiliated transaction. And then in that case, in the all the periods, in the cover periods, should be reported the TP documentation on the yearly basis. In terms of the renewal, as I mentioned before, that the applicant or the taxpayer could make the renewal APA period for one times, and it should be submitted in the period of 12 months or 6 months prior to the APA period, the next APA period. So in that case, if the taxpayer or the applicant have already, like in the 5th years of the APA cover period, so in that case, if the taxpayer or the applicant want to renew again, and then in the last year of the APA cover period, they have to submit the APA renewal, and then it is only, as I mentioned before, it is only granted to one more APA period. Next is I want to also give an update of the mutual agreement procedures. Please, next page, please. Regarding the MAP, because it is stated clearly in the BEPS recommendation or BEP action 14 minimum standard. So what we already being done in our domestic regulation, it is in order to fulfill or to achieve this recommendation. So that's why what we regulate in the MAP, it is again in order to fulfill what's already being said in the BEP action for the minimum standard, and also in accordance to international BEPS practice. So in terms of the guidance, I already mentioned before, and then now the second, in order to prevent the dispute, so Indonesia, it also run what is already being said in the Article 24 5 in the DTA actually, or in the model convention, that Indonesian tax treaties contain provision which require the competent authorities to endeavor to resolve by mutual agreement any difficulties or any doubts arising as the interpretation or application of their tax treaties. So in this case, Indonesia is really trying to fulfill this also. So in this case, Indonesia and also in other jurisdictions as a partner try to achieve and to pursue the elimination of double tax in case that to provide it for in the tax treaties. So and also regarding the rollback in the APA, it is also in order to fulfill the international best practice regarding preventing any disputes. Next, please. Sorry, I'm a little bit hurry, but because I know that maybe the time is not much anymore. So, pardon me if sometimes I'm not speaking quite clear because I want to like in hurry to finish it. In terms of the availability and access to MAP, actually Indonesia opened as many as a channel in order to provide access for the MAP. So in this case, Indonesia tax treaty allow taxpayer to submit MAP request to the competent authority of the state in which they are residents. So it's not directly to Indonesian competent authority, but it made through the competent authority that they become residents. And then the partner will notify Indonesia that it is a submission from the taxpayer, something like that. Indonesia also provide access to MIP requests for transfer pricing cases and other cases related to the application of the treaty and or domestic law or anti-abuse provision. So in that case, it's not only about not only about the transfer pricing issues, but it is also regarding the implementation of the tax treaty. And then the MIP request must be submitted within the time limit as stipulated in tax treaty, or if there is no regulation regarding that in the tax treaty, certain tax treaty, it is no later than 3 years from the first notification. Yeah. And then Indonesia must profile statistic rules and guidelines published on the website of OECD and Indonesia Tax Administration. So in that case, if you want to know regarding the MAP, an update and the statistic, you just may go to the OECD website and also to our website in the Pajak Go ID. And then as the MAP, as APA, there's also no filing fee for the MAP application. Next, please. So in terms of the resolution of MIP cases, so Indonesia really committed to resolve the MIP cases within 24 months. So it is slightly different, but the OECD said on average 24 months, but Indonesia want to make it certain in 24 months. But in our next regulation, in the DGT regulation, it can be extended until more 24 months again, as long as fulfill the certain requirement that's stipulated in the regulation. So 24 months, it can be extended with 24 months as long as fulfilled the certain requirement stated or stipulated in the DGT regulation number 16, 2020. As I mentioned before, I don't want to explain about more about the dedicated map division. I just want to say that we have like a sufficient number of personnel of the treaty analysts. So in this case, we are really trying hard. We are really trying as good as possible, I mean, we are really trying so hard to fulfill the 24 months period to settle the case. And then I just nice to inform you that the performance indicators of MAP is not based on the amount or sustained audit adjustment or how much tax revenue it's maintained, but it is solely to the quality that we could achieve in the negotiation. So we want to like make it fair since it is a dispute resolution. So again, it said that the performance indicator is not based on how much money we could sustain from the audit processes or audit adjustment, but rather than the quality of the MAP itself. But I want to tell you that Indonesia made reservation to adopt the para 5 of Article 25. In this case, it's regarding the arbitration. So in our tax system, we not recognize the arbitration system. So the only way for the international tax dispute resolution is using the mutual agreement procedures. Next. So in the implementation of MAP agreement, any agreement reached in MAP decision will be implemented notwithstanding any time limits in the domestic law. So in that case, I think MAP implementation is like supersede the limit by the limitation of any domestic law. In terms of the remedies, MAP and domestic remedies, MAP and domestic dispute settlement, in this case, objection and appeal, may run simultaneously. So in that case, if the taxpayer submit the MAP, the taxpayer also may submit an objection or appeal. So it can work side by side. But in this case, if the dispute has been adjudicated by the tax court in this case, MAP negotiation has not in the position that our position is differ from what is already being achieved or being adjudicated by the tax courts. So in this case, if the MAP is still going, I mean the MAP negotiation is still going, and then the objection is already concluded and they have already reached the verdict. So in that case, the MAP will be stopped because in this case, DGT might be bound by the tax court decision. So we cannot have different position with what is already being adjudicated or being settled by the tax court. So please be aware of that. So I will reach the last presentation. The last presentation. I just want to update regarding the MAP transfer pricing statistic. I mean MAP statistics. Please go to the next slide. So I just want to summarize the position of the inventory nowadays. So this is the inventory figures now. So we have like 57 cases for APM and MAP. It's already closed 82. So from this 57, for BAPA, it is, sorry, I'm not, okay. Yeah, the inventory is for BAPA is 25, and then for MAP, it is 31, and then we only have UAPA 1. That's the inventory, but I believe that even today, I received many application or many submission. That is around 3 or 4. So in that case, our inventory and for today's position is like become 51, I think, I believe. And it is conclude my presentation. Again, my apology if I speak not clearly because I really want to I mean make it fast since our time is already very limited and we have still 2 more panelists. So I return back the time to Ms. Christine, please. Thank you for the kind attention.
Yes, thank you very much, Ibu Ewi, for your very comprehensive presentation. Sorry for disturbing your time, but ladies and gentlemen,
it's okay.
Yeah, ladies and gentlemen, there are several important points from Ibu Dwi's presentation. Ibu Dwi has presented to us about the updates on the APA, the Advanced Pricing Agreement, which you may look at the Ministry of Finance Regulation number 22, year 2020. So this fresh from the oven. In July, just come up the regulation. And also, Bu Ewi also update us on the mutual agreement procedure, which is regulated by the DGT regulation number 16, year 2020. So I will not repeat all the presentation, but here the thing that you have to consider is regarding the APA, you have to consider the collateral issues. This is the important issues to be noted for all the taxpayers who wants to apply for the APA, and also for the mutual agreement procedures. Please also note it that the resolution of MAP cases, Bu Ewi mentioned it's around 24 months, but it can be extended in certain case, and there is no arbitration system. Yeah. And then we also can apply the MAP and domestic dispute settlements simultaneously. Okay, so I think that is the important issues that I can get from Ibu Dwi's presentation. And now let's move on to our second speaker. Our second speaker is Bapak Dhani Septriadi. Pak Dhani will present to us regarding the relationship between COVID-19 and the impact on the limited risk entity, and also the tax dispute landscape and developments in Indonesia.
Saya Pak Bu Christine ya, sorry. Yes. Kalau lihat schedule-nya Pak Didit dulu tuh, Permana, bukan?
Enggak Pak, Bapak dulu.
Oke.
Yeah, before we listen to his presentation, I will share his CV. Yeah. Pak Dhani is the senior partner of Dhani Darussalam Tax Center and also the lecturer at graduate program in tax policy and administration science, and also in master in accounting program at the University of Indonesia. And he received master degree in tax policy and administration from the University of Indonesia, and a second master degree LLM in international taxation from Vienna University of Economics and Business Administration, Austria. So now I invite Pak Dhani to share with us. Pak Dhani, the floor is yours.
Okay, thank you, Christine. So who will share the screen for me? Who will help?
Yeah, I think Ms. Pak Reza will share the screen. Yeah. Okay,
thank you. So thank you all. I would like to present about the transfer pricing development and dispute settlement. I already read some of the questions from the participants, and then I think it's relevant that we discuss regarding my presentation. So, okay, this is the agenda about the COVID-19 and the impact on limited risk entity, and then the tax dispute landscape and development. So, next slide. So, this is that based on the current situations that the multinational face, not only in Indonesia but also is in the global, there is an economic downturn because of the COVID-19. So I will discuss about what is the impact of the COVID-19 and then with the limited risk entity. So I inform you about the definition of limited risk does not mean there is no risk. That is, the associated enterprise, like independent enterprise, can sustain genuine losses, whether due to heavy startup costs, unfavorable economic conditions, like the situations, inefficiencies, or other legitimate business reasons. So this is relevant. This paragraph from the OECD is relevant when we discuss about the unfavorable economic conditions, that is this COVID-19. So as we know that in Indonesia that we have, for example, several PSBB ketat ya, PSBB ketat for almost 3 months, and then another 1 month approximately about the PSBB that is impacted to the company. There is a reduction or even until there is no provided of the service and goods and services in that period. So there is a shock from the productions, goods and services. On the other hand, the fixed cost is still the same. That means the company have to survive with there is a liquidity problems. So that's we have to consider about how about this 2020 transfer pricing documentations or the impact for the transfer pricing. So the first one is that the revision of the searching criteria for 2020. That when there is a searching criteria, you have to include, you may include the loss-making companies. So because there is possibility that this year the company is also considered losses. And the other is that inclusion companies with progressive decrease in sales. So there is a 2 indicator that you might consider during the searching criteria for in the TP documentations. There is inclusion loss-making companies or the inclusion companies with progressive decrease in sales, because that we know that there is a decrease in volume and then also maybe decrease in price, but the cost may be higher, and then also maybe increase because of a lot of costs have incurred during the pandemic situations. And then the other thing that we could consider is that the period of the period of analysis. Maybe we could include the consolidated of the listed company, because the listed company is they have a regular publication of the financial statement, and then also they are earlier submit or publish the financial statement than from the databases. So we could consider that the listed company as a comparables company. And the other period of analysis that we could consider is the comparables on previous recession years. Although we understand that the pandemic situations, conditions, the economic conditions is different with the recessions actually. For example, in 2008. But as we know that 2008 is also in the recession conditions, and then now in global, even in Indonesia, already acknowledged that we are already in the recession years. So we could consider the comparables on previous recession years as a comparables for selecting the comparables. And then the next that we could consider also the adjustment of pre-crisis comparable data. That we can use the regressions based analysis, for example, that the estimation expected contraction of 2017 until 2019 operating profits given reduction on sales. That means that the database in the 2017 and then until 2019, the operating profit, then we can compare with the reduction on sales in this year. So we could use the statistical regression-based analysis. So we could make an adjustment before crisis and then with during the 2020 pandemic because of reduction of sales. So we could adjust it that with the consideration of the reduction of sales. Regarding the TP documentation and APA, inclusion of the COVID-19 impact that recently DGT already issued the new regulations. So review of APA or proactive request and update to the DGT, because maybe for the several taxpayers is already submitted the APA. So they have to review and proactive about the development, the pandemic situations, because everybody still do not know when the pandemic will end. So that's that we could consider about the COVID-19 impact and then about the limited risk. For some multinational company in the global also, they could consider to restructure the agreement or the contract, because in normal conditions, in normal agreement, there is a clause about the extraordinary conditions. That could be the pandemic. It could be considered as the extraordinary conditions that the parties, not only the related party or the independent party, may revise the agreement. So this should be considered during the pandemic situations, not only this regarding comparables, but also how you may consider to restructure the agreement or the transactions. Next slide. So this year is in the difficult situations that the government is already provide the tax incentive by reducing the corporate tax rate from 25 to 22%, and then give the reduction for the installment corporate income tax to 30%, and then until to 50%, the reductions. But in my view, that based on the discussions from the several taxpayers, that maybe that is still not enough for them. That there is a possibility that the corporate income tax for 2020 maybe in the overpayment situations. So that we have to understand that if there is in the overpayment positions, that this is automatic audited or dispute regarding refund in 2020. So we should consider this as a matter of policy and practice in Indonesia, that we have to anticipate about a lot of taxpayers in Indonesia in 2020 could face in the overpayment position, and then will be audited in 2021. That we have to consider also that there is possibility there is a dispute during the audit that could be prolonged until to the objection stage or into the tax court. Tax court is already overloaded. Presently, there is a news mentioning about the backlog of the case handled by the court. In addition to that, during the pandemic, the court also have closed following the pandemic, and then also in addition to that, there is also another already open and then closed again because of the pandemic situations. Even that they already make a virtual or online for in the Surabaya and Yogyakarta. We hope that they could consider about how to make a virtual or online court hearing, because it would be safe for us. And then in addition to that, the case file is a lot. If you can see that the DGT performance in 2019, the performance report states only 40% the DGT win the case. So this could consider also as a strategy or a policy how to face the future dispute settlement in advance or in advance, just to avoid the audited or into objection or in the court hearing during the pandemic, because I already have represent clients in the objections and in the tax court during pandemic situation is better is not dispute in the court presently. Yeah, if we can avoid in the dispute in the court, it will be helpful for the taxpayers, because it will helpful for about the liquidity of the taxpayers. If we avoid the overpayment situations, it will be helpful the taxpayers to survive, because the taxpayers need the liquidity immediately. If the taxpayers do not have or cannot afford cannot financing the operational, so the taxpayers may end with the bankrupt, and then if the bankrupt, then there is no income tax payable could be provided to the government. So we have to avoid the dispute in advance during the pandemic situations, in my view, because it is critical. They need the liquidity, and then if they can survive during the pandemic situation, they can grow again and then can pay the tax in the future. So the outlook that, in my view, is that the government need to foresee and mitigate the risk of upcoming wave of refund of audits or disputes, and then voluntary compliance should be encouraged, and then by using the CRM, compliance risk management, it should be helpful rather than to audit every taxpayer, and then that may create another dispute that is already backlogged in the tax court. So I think that's all that we have to consider. This is an extraordinary conditions that we should consider this not as a regular economic conditions, that the taxpayers still have cash flow to handle objects, to pay during the audit dispute or in the objections or in the tax court. But in current situation, I believe it is hard for the taxpayers or in Indonesia now to pay a lot of cash flow, money during the dispute in the audit, because they do not have sufficient cash flow during the pandemic, because there is a reduction of sales, higher of the cost, decrease of the sales price, and then higher for the health and safety. But the dispute still long, so they do not have time. They do not have time to survive because the fixed cost still exists. So I think that's all my presentation about the importance of that transfer pricing in the pandemic situation. Thank you, Christine.
Yeah, thank you very much, Pak Dhani, for your interesting presentation. Pak Dhani has presented to us regarding the COVID-19 and its impact to the transfer pricing comparables. It can be seen from the revision search criteria, period analysis, adjustment of pre-crisis comparable data, and also regarding the TP documentation, and also considering the APA. And the last of the Pak Dhani presentation, he shared with us regarding the interesting fact that might be raised regarding the tax dispute landscape and the developments, which might increase in tax audit and dispute because of the tax overpayment, and the tax court can overload already, and also it is important for the DGT to mitigate the risk of the waived tax refund from the taxpayers, and it is also advisable for the DGT to apply the CRM. Okay, so that is the important points from Pak Dhani, and thank you very much, Pak Dhani. And last but not least, I would like to invite Pak Permana Adi Saputra from PB Taxen to share with us regarding the transfer pricing cases in Indonesia. But before, I would like to introduce him first. Pak Permana serves as the Vice Managing Partner in PB Taxen. And also currently, he also serves as the Secretary General of Kompartemen Akuntan Perpajakan IAI. He is graduated from University of Indonesia with a Master in Management and Bachelor in Economics. Pak Permana, the floor is yours. Thank you.
Thank you, Bu Christine. Assalamualaikum warahmatullahi wabarakatuh. Salam sejahtera buat kita semua. Good afternoon, Pak John, Mr. Kiso, and Mr. Makbul, and all panelists, moderator, and all participants. Thank you for this event. I think this is a very good event. You know, I just realized there are almost 4,000 people as a participation in this event. So it's a very big event. All right then, so probably next to the introduction, just skip this page and next page, please. Okay, all right then. It is a very interesting talking about transfer pricing because for the last 10 years, Directorate General of Taxes, they are very active enforcing transfer pricing in Indonesia. I believe this is in line with the OECD, as Pascal already mentioned earlier in his presentation, that OECD is starting to focus on transfer pricing since 2008 because of the global financial crisis in the world. And Indonesia, starting 2009 and 10, 11, there, DGT is very active, issue the new regulation or the regulation related to the transfer pricing. And also, I believe DGT also active doing a discussion with the OECD and join the meeting with OECD and also adopting the OECD transfer pricing guideline to become our regulation. 60 to 70% of world trade transaction, transaction between related party, this is dominated for the world trade. And that's why the transfer pricing is one of the major issue on the cross-border transaction and also domestic transaction. And transfer pricing become an issue as well in the major transaction, especially for Indonesia for domestic transaction. Therefore, we need to understand more about transfer pricing. And in 2015, OECD issued the BEPS action final, which is one of it is related to the transfer pricing documentation. And Indonesia adopted this BEPS action 13 into regulation, which called PMK 213 in 2016. So I think this is the starting era for the transfer pricing transparency era in not only in Indonesia, but also in the world. Since then, I think since 2010, probably a lot of issue on transfer pricing, then a lot of dispute on transfer pricing as well, and especially after the transfer pricing transparency era. Therefore, the DGT and Ministry of Finance trying to simplify the dispute prevention for transfer pricing matter by issuing the update advanced pricing procedures in PMK 22. And as we understand, the COVID-19 pandemic happened in the world, is create significant changes in the global economic condition, and definitely which will impact significantly to all the group of companies. Next. Next, please. Yeah, I just want to brief about the APA itself, but I think Bu Dwi already explained about this. So I'm going to give some highlight on the something that probably I really focus on in the certain point. Next. Next. Not this one. Yeah, okay. This definition of special relationship under income tax law, there are three kind of definition. It's like a capital participation, and then because of the control, and also because of the family relation. So in the PMK 22, 2020, they provide more explanation on this. I think the next slide will be comparison between the PMK 22 and the Indonesian tax, income tax law number 36, and also government regulation number 94 year 2010. So based on the income tax law number 36 year 2008, the capital participation, they provide the example of a special relationship under a capital participation condition, but in the government regulation and the PMK 22, they don't provide further explanation on this. The one that interesting for me is actually related to the control, because under the income tax law, the control in the elucidation of ITL 36, they provide the explanation that special relationship between taxpayer may occur because of control through management and use of technology. And then in the government regulation 94, they provide in detail about the special relationship example under control, which include the direct management control and indirect management control, which is they provide some example on that. Let's say what is the direct management control, which is if, let's say, one of the company who has a director, PTA have a director, and PTB, for example, have the same director, Mr. A, so they become a related party. As well as indirect management control, they also provide an example what the condition on the indirect management control. However, in the PMK 22, they provide a condition, special relationship condition under control, which is, for me, in my opinion, this condition is broad, and then probably it's kind of really too difficult to understand the condition. So this is something that we need to have a discussion or detailed discussion more with the DGT in relation with this condition. They mentioned that the condition is one party controls another party, or one party is controlled by another party. I think this is quite clear. And then number two is two or more parties are under direct control of the same party directly or indirectly. And then next slide. Or there are same person directly or indirectly involved in or participating in the managerial or operational decision making of two or more entities. So this is something that I mentioned is probably it's a bit wide definition. Parties who are commercially or financially known or declared to be in the same business group. So yeah, this is something that we need to understand more. Is it because of what kind of the example of this to create a related party under this condition? And also one party declared to have a special relationship with the other party. Is it because of, let's say, for example, based on the audit report saying that related party, so it means they are become a related party? This is something that we need to elaborate more on this condition. Next. Next, please. Yes. And then definition spatial relationship under a family relationship. I think this is the same with the ITL and NTL, and then the PMK22, they don't have any further explanation on this. Next. And the application of arm's length principle based on the article on the PMK22, I think next slide, please. Yeah, PMK22 give more detailed explanation on this. I think this is a good thing for a taxpayer to understand what is the arm's length price or range on the tax office definition. So based on pair 32 and pair 43, basically the arm's length price consists of single price and range, which is, if you're talking in the pair 32 and pair 43, arm's length range refer to the interquartile, mean first quartile and third quartile. While in the PMK22 year 2020, they also provide information, they provide regulation clause related to the point and range. It's quite similar. So they have a arm's length point, arm's length range. However, the difference is related to the range itself. If we are talking about range, in the PMK22 stated that the range, if you have two comparables, means the range will be full range, minimum to maximum value. Then if you have 3 or more comparables, you will have a first quartile and third quartile value as an interquartile range. So I think this is quite clear and more explanation for the taxpayer in the view of the arm's length range. Next. Yeah, the definition of arm's length price. This is also quite interesting. In the pair 32 and pair 43, they don't have any clause on that. A lot of dispute with the Indonesian, the DGT, the tax auditor, because of this issue. And the pair 22, actually, they don't provide a detail, but they have an example. They provide an example calculation in determining the arm's length range, arm's length price using median point, actually. But in PMK22, they provide more clear guideline in which the arm's length price is referred to the arm's length point or the most precise point or the median value. I think this is a good clause in the PMK22, so give us more clear on the guideline, on the regulation. Next. Yeah, just to give you a brief about the transfer pricing, that transfer pricing is not an exact science and it's not a black and white. So many analysis, judgment, and supporting documents. Therefore, I think, as Pak Dhani mentioned earlier about the COVID pandemic situation, this is a very difficult situation for all of us, and then also very difficult in preparing the transfer pricing analysis, because you need to have more and more analysis, judgment, and supporting documents in order to prove that you are in accordance with the arm's length principle. Next. I give some brief about the most common cases, transfer pricing cases in Indonesia. The first one is a management service transaction. So just to give a very quick, that ABC PT Ltd providing service to PT ABC. So the tax authority opinion, they said that because of the taxpayer did not provide sufficient supporting document to prove the existence and economic benefit of this management service transaction. So from their perspective, the perspective of service user as an audited party, the tax auditor made judgment and disallowing the entire amount of management service fee. So this is most common transfer pricing dispute. Therefore, the taxpayer need to be more careful on the supporting documents, because most of the issue is how to prove that this transaction is really happened. So this transaction is not quote unquote as a fake transaction just to shift the profit from Indonesia to other country. So this is something that you need to prove. Transfer pricing documentation only to prove the arm's length price, but they don't provide the supporting document to prove the existence and economic of this transaction. So therefore, the taxpayer need to prepare more and more supporting document to prove this existence and economic benefit. Next. Yeah, the next most common issue on the transfer pricing is related to the selection of comparable companies. And in this case, let PT XYZ do like sales transaction with PT XYZ PT Ltd, XYZ PT Ltd. So the PT XYZ, they provided the TP documentation using 5 comparables, but the tax authority opinion, they only accept 3 comparables out of 5 comparables from the local file of the taxpayer. So this is also the very common cases, which is the issue is how to convince the tax office about our comparables. Therefore, the taxpayer need to be more sure about the comparable they choose in the TP documentation in order to defend their position in front of the tax auditor. Next. The last case study that the most common transfer pricing case in Indonesia is the selection of a transfer pricing methodology. So let's say in this case, the PT XYZ, they have a sales transaction to related party XYZ PT Ltd, but they also have a related an independent party transaction, with PT AAA, for example. So in this case, tax authority opinion, they said that, oh, we better using a CAP method because CAP method is the most appropriate method because you sell exactly the same product. So this is something that you need to be focused on the comparability issue as well, whether both transaction is comparable enough. And then so you need to do like more detail on the comparability analysis in order to prove whether this is not as PTA AAA transaction cannot become comparable with the sales transaction with XYZ PT Ltd, or it might be the tax authority opinion is correct that PT AAA independent buyer can become the comparable for this transaction. So then again, the taxpayer need to have detailed comparability analysis on this to prove that the TNMM is the most appropriate method they use. Okay, next. Yeah, I think Pak Dhani has already shared about this, about the transfer pricing during pandemic period, that sales price and volume of most of the companies decreasing and cost per product increased dramatically because of the fixed cost still the same, but the sales decrease and health cost is also increased. And probably there are a few expenses decreased, like the tax expense because of the government facility and salary and wages because of some of employee they didn't work, they don't go to the office, and then the company cut the salary and wages. But the bottom line, the company profit will decrease significantly and even will create loss for the company. So then the issue is transfer pricing issue for 2020 become critical because to prove the arm's length that our transaction with related party is already in accordance with the arm's length principle, we need to prove very, very careful on this. I think Pak Dhani already explained about this as well in this presentation. Next. Yeah, I think this is Bu Dwi is also already explained about the dispute settlement for transfer pricing cases. All right, I think that's all from my presentation. Bu Christine, go back to Bu Christine.
Thank you very much, Pak Permana, for your concise and clear presentation. So there are several key points. The first one is the highlight of the APA regulation, PMK 2 year 2020. I noticed that there is spatial relationship regulation, which is difficult to understand. Maybe need further clarification on that regarding the control criteria in PMK 22. And also, but on the other hand, the PMK 22 give more clear explanation about the ALT. Yeah. And then at the second point, Pak Permana explained to us about the transfer pricing cases regarding the transaction, the selection of comparable companies, selection of TP method, and also lastly, Pak Permana mentioned about the transfer pricing during the pandemic period, which is also influenced by this situation. And now we move to question and answer, but because we have so limited time, so I will read one question regarding the TP guideline. Maybe this I will ask Ibu Dwi. Will DGT issue the additional TP guidelines in relation how to taxpayers could be in TP compliance in conjunction of the COVID-19 outbreak? Where we maybe to answer this one.
Thank you, Christine. Thank you for the opportunity for the questions also. Yeah, we indeed understand that this COVID situation also make our economic situation face a very difficult time. The turbulence, the contractions of the economic growth, it is also really effective the businesses of the taxpayer. So that's why I think in order to respond the situation, actually we already, as I mentioned actually earlier, the DGT regulation number 14 that it is submitted or it is stipulated just a few weeks ago on the 18th of September. Oh, sorry, 17th of September 2020. So in that DGT regulation, saying that it is we fully understand that because of this pandemic situation make explained by Pak Dhani, and then we fully understand of that. So it is allow the adjustment of the profit level actually submitted by the APA application, by the APA applicant or by the taxpayer. In this case, we consider that it is very possible that operational profit is become lower due to the pandemic situation or because of the effect of the pandemic. So in this case, we are provide the relaxation. So you may find the form to be fulfilled attached with the regulation, explain or showing that the company is really affected by the pandemic situation, and then it is causing the profit or the operational profit is become lower. So in that case, we already respond this condition, and then it is also as a response for the taxpayer who may want to submit the APA, but and then the profit, the operational profit is become lower due to this situation. So I think this is very specific. A question, Bu Christine, as I aware that the time is already, I mean, past that it should be.
Okay, thank you very much, Bu Ewi, atas for the answer, and hopefully, because there is no name here, so hopefully the one who asked can try to search for the regulation mentioned by Bu Ewi. Okay, so we already finished our session now. Finally, I would like to thank...
Regulation number 7.
Yes, Ibu? Bu Ewi? Okay.
Yeah. I mean, there is many relaxation actually in those DGT regulation. So just please check the DGT regulation number. Number 14.
Number 14 year 2020. Yeah.
According pricing.
Okay. Yes. Thank you.
I just want to add something. Thank you.
Okay, thank you, Bu Ewi. Okay, finally, I would like to thank to all the amazing speakers for this session, and also to all the participants who already joined today's panel discussion. And hopefully we can get valuable knowledge and insight regarding the current update on transfer pricing development and dispute settlement. Now I would like to pass on to MC again. Monica, thank you so much. Good afternoon.
Okay, thank you Ibu Christine and all of the panelists for the fruitful discussion. So could you please turn on the camera, but because we would like to do a group picture for the session. Okay, smile. Thank you very much, Ibu Christine, Ibu Dwi Astuti, Bapak Dani, dan juga Bapak Permana. Ladies and gentlemen, now let's start our next agenda is presentation of use of data to limit the tax avoidance and evasion. The speaker is Mr. Makbul Alji, the director of Bureau van Dijk, a Moody's Analytics company. So Mr. Makbul, are you ready to start your presentation?
Yes. Assalamu alaikum. Yes. Bismillahirrahmanirrahim. Assalamu alaikum wa rahmatullahi wa barakatuh. I would like to thank you all for inviting me to this honored gathering. I will, if my presentation is loaded, I can start this quickly. So, can I have my presentation? Thank you very much. Okay, so if we go to the introduction, the next slide. Yes, thank you very much. The presentation, hopefully I'll run through it quite quickly so we can save some time. The discussion is tax avoidance and tax evasion. So I will look at some of the definitions of tax avoidance, tax evasion. I will look at some of the size of the global problem in terms of revenue lost to the tax administrations and the international efforts that have been underway to tackle these, especially from OECD, IMF, and other supranational entities and governments and so forth. The role of data, revealing conspicuous structures. Here I will look at a risk model where we can combine the internal data of a tax administration with that of the of Bureau van Dijk. And then I will have two real examples where I have only used Bureau van Dijk data and ran some algorithms on it to reveal some avoidance structure, the possible avoidance structure with a Dutch partnership. In the structure, in this is a US HQ headquartered multinational impacting on a Southeast Asian large manufacturing subsidiary. And the second example would be of a complex secretive structure involving an individual beneficial owner with his business empire, possible illicit source of funding, and tax evasion possible scenario. And after the takeaways, there will be a poll question, 3 poll questions, which I will read out, and I would like you to answer those, fill in those poll questions, and I would like to thank you in advance. But I will read out after the discussion, after my discussion. Thanks. So if we can move on to the next slide, please. Thank you. Okay, here is a snapshot of what tax avoidance and tax evasion to some extent means. And just to, I mean, I'm sure you are aware of the differences, just to clarify what it really means in that sense. Tax avoidance, tax evasion. I have used the definition from Her Majesty's Revenue and Customs manual, which are online. But this definition for tax avoidance, this definition is not too dissimilar to the understanding of tax avoidance generally. Basically, tax avoidance means circumventing the law, not in accordance with the spirit of the law. Here, the avoidance could be aggressive, abusive, serial, and detrimental to the economy. The definition for tax evasion is probably more simple. It is deliberately not disclosing taxable income at all. That is not just forgetting or not disclosing taxable income due to an error. This is completely avoiding disclosure to the tax administration. And then there's a gray area of tax planning. But tax planning is just being prudent. A lot of the accountants and consultants will say it is just prudent, is being tax planning, being prudent, adhering to commercial fair practices, and claiming all the tax reliefs and deductions that are available and claimable. But the slight difference between that and avoidance is that avoidance is aggressive. It's not in the spirit of the law. It's trying to circumvent the law. So these are the kind of definitions we have to live with. The challenging tax avoidance is not easy. You have to prove that there is something there. There is always challenges around the permanent establishment. On the substance test, we have to run substance tests and various other things to show that there is an avoidance or there is an intent also. So this can be complex. So it's a mute area, but quite a lot of work is done by tax administration in this area to recoup a lot of tax being lost to them. So can I have the next slide, please? So here we have the big figures. About $240 billion is lost annually due to tax avoidance by multinational corporations, companies. This has been cited by the BEPS program, and you will find on the BEPS website this amount. But I suspect this is quite an underestimation, because this is way back 2015 or maybe earlier than that, the latest figures or 2019 figures from Finance and Development publication by International Monetary Fund, article by Nicholas Shaxson, suggests that tax havens collectively cost governments between $500 billion and $600 billion a year lost in corporate tax revenue. On the individual beneficiary front, according to Zuckman, an economist at the University of California in Berkeley, suggests that around $2.6 trillion are stashed away in offshore tax havens. There has been there is another figure of about 190 billion of global tax revenue lost through offshore tax evasion, which is different from avoidance. Again, I suspect this is an underestimation. Zuckman again in 2015, economists came up with that figure. I suspect that is much higher than that. And after the pandemic, I suspect that will go up again because, for example, in UK, the furlough scheme that's to support the self-employed. There have been considerable number of incidences where there have been fictitious companies, fictitious businesses trying to claim money from the government for the pandemic. So I suspect it will all come out in the wash later on what the evasion amounts would be probably in UK. The considerable amount of work has been done by the OECD and IMF and other super national bodies. The BEPS work has been tremendous. It's covered quite a wide area from digitalization from Action 1 to Action 15, and there's still obviously continuation of work such as the tax challenging arising of the digitalization economy, as you know, the OECD General Director General this morning explained to us that this is not an easy area to look at. So there is a lot of work, but BEPS have done a lot of work. In a sense, BEPS 13, the country by country reporting on multinationals which have a operating revenue of 750 million euros or maybe 870 million US dollars. They have given a high level of indicators to look at risk. The country by country reports give you quite a bit of information now at high level. The information on tax jurisdictions, revenues, whether they are related or unrelated, profit and loss before income tax on cash basis, income tax on accrued basis, stated capital, accumulated earnings, number of employees, tangible assets, and then also you have constituent entities resident in the tax jurisdictions, organizations or incorporation if different from tax jurisdictions or residents. So that's an important area of residence where you can probably use for checking permanent establishment, various other things. Main business activities, whether it's holding activities, managing intellectual property, and so forth. So BEPS 13 has given a lot of insight. The data is there, and it started being shared, exchanged with tax administrations. And how effectively it's been done is I'm not 100% sure, but some of the tax administrations are trying to use the data to do the risk assessment, trying to look at flags with that data. And in that area, the OECD have issued a guidance, a toolkit on handbook on effective tax assessment. They outline some 19 tax risk areas where they can use this data along with other information and data available to tax administrations. So there has been considerable work there by BEPS and other supranational bodies. There have been 135 plus countries collaborating on the implementation of BEPS package. So there is quite wide share unity on this, and a lot of tax jurisdictions have included the BEPS information, BEPS guidance into their legislation. So that's quite helpful. So there's a legislative cover behind it. 90 plus countries have signed the multilateral instruments. The panel discussion after me will probably look into this from an Indonesian point of view. Then there is the common reporting standards requiring for financial institutions in participating countries' jurisdiction to help fight against tax evasion. There are 100 plus jurisdictions committed to the CRS. And under Action 12, under CRS, there are mandatory, there's model mandatory disclosure rules for avoidance arrangements and opaque offshore structures. the hallmark for OPEC offshore structures, especially targeting passive offshore vehicles that are held through an opaque structure. Basically, your partnerships, your limited liability partnership, limited liability corporations, or the famous Dutch CV, limited partnership, and BV, the private limited liability structures. For example, the Starbucks case where the European Commission are taking a real interest on the inadmissible state aid provided by Netherlands there. In Europe, under European Commission, there are a number of directives. We have the anti-tax avoidance directives covering the control foreign company rules, hybrid mismatches. Then there's this DAC, DSE DAC 6 European directive on cross-border arrangements, disclosing hallmarks of reportable cross-border arrangements. The disclosures from intermediaries and taxpayers, this disclosure should have started in August 2020, at least in Europe, but because of the COVID-19 pandemic, this has been put back probably by another 6 months. Then you have got the number of public disclosures are being made to combat tax mischiefs. For example, the work of International Consortium of Investigation Journalists, ICIJ, and they have this database available on the website, and you can find a lot of this information on offshore leaks, Panama Papers, Paradise Papers, and so forth. The interesting thing is that those informations are maybe a bit dated, but a lot of the companies may have gone into liquidation or may do not exist, but the individuals' names are there, and these may be found in the Orbis database where they may be directors of other companies. So there is an indication from these databases of the behavioral aspect of individuals. Once they've been doing something, hiding something, then are they doing this kind of thing, or now in their current businesses and so forth. So there are possibilities, so data can give you some insight on that. So there are, as I said, a number of toolkits around risk assessment guidance, especially on the handbook for effective tax risk assessment. And then OECD have developed this program of tax inspectors without borders, and they have been quite active in Africa, in some of the Asian companies, developing countries, in South America, where they have been sending ex-retired tax inspectors around to assist tax jurisdictions in recovering lost tax. So they have got a report. I think it was submitted last month, and this is very interesting reading if you go on the OECD website. So you got that. You also have the beneficial ownership implementation toolkit, which is quite a good toolkit, quite a good read. A joint publication by the Secretariat of the Global Forum on Transparency and Exchange of Information for Tax Purposes, and the Inter-American Development Bank. So it's a joint effort. It was published last year in March. So this is a good read for people to look at the beneficial ownership side of things. Yes, next slide, please. So the role of the data in revealing conspicuous structures. I think if you combine the data that is held by tax administration and what is available through Bureau van Dijk, this makes a possibility of developing some very powerful risk models by blending the data. So in a way, tax authorities do have, tax administration do have a lot of data, direct tax returns data supporting documents. They have the electronic local gap XBRL digital data in the markup XML extensible business reporting language relating to accounts and tax computation. So they have a lot of this digital data. They have indirect tax and employment data on individuals. They have financial institution, common reporting standard data on banks, Pascal did mention some of the Swiss bank accounts information and so forth. Standard of bank accounts gives you information on residency, possible hallmarks on identifying cross-border transaction, use of special purpose vehicles, and so forth. And then, of course, you got this detailed BAPS 13 data, which is in the vaults of the tax administration, and hopefully they'll be making some good use of that. So that's all that data from tax administration side. From the Bureau van Dijk side, the data has grown considerably. I've been using Bureau van Dijk data for 20 years. I've been working for Bureau van Dijk for now nearly 5 years, and I have seen some considerable growth in the data they have. So way back 2010, I think they had some 50 million coverage of companies globally. Now, 10 years later, there are 375 million companies globally in their database. They have company financials, including relating to foreign companies and so forth. They've got some financials of 40 million is in there. They got historical data. They got financial strength information on corporate credit risk score, information on some 363 million companies, which have and there's some 334 million companies that have a recommended credit limit. There's mergers and acquisition data. There are cross-border investment information, intellectual property patent data, some from 125 million patents globally, linked to some 1.9 million BVD companies. So this, of course, then on transfer pricing side, you got the royalty rates, global coverage on beneficial owners. There's some 325 million people in the BVD database. They're shareholders, directors, and managers. And we have over 1.2 billion ownership links, historical and active, in the database. So in all, there is a heck of a lot of data. The combined data of the tax administration and the BVD data opens up many doors for data mining, AI-based, artificial intelligence-based analytics, and so forth. So in this modern day era, there are a lot of possibilities of using this kind of digitalized data to doing risk work, to look at for avoidance structures, to look at evasion and so forth. And we as a company have been working with some of the tax administration on projects of ingesting the whole of the Bureau van Dijk data world into their data lake or into their systems, so that they can run some complex analytics using some very qualified data scientists. Some of these guys got double PhDs in data analytics, so when they see this kind of data, their day has been made. So they can find a lot of structures, they let the machine talk and find those structures and so forth. So it's very useful data we can find. Having said that, if I go into the next slide, please. Yeah. So this is a real example. I ran some algorithms earlier this week on BVD data to reveal a possible avoidance structure. Here, feeding in information on US multinationals that have Dutch BV, CV entities, have entities in low tax jurisdictions, and the subsidiaries in the Southeast Asia jurisdictions have an operating revenue at least of $10 million or over annually. So the purpose of that series of algorithms I ran in a live system last week, I was able to target US multinationals which have a which use a Dutch BV holding finance investment entities. And this is quite common, they do this. They have in the midst of it a Swiss intellectual property holding, which has been identified in the structure. If you look at the...
I'm one of the speakers, so they might call me at some point, so apologies.
Sorry, yeah. So if you can see the Swiss company, which is the white circle, which is the holding company, IP holding company, but you got the American multinational is in blue, and then you got the Dutch holding BV company, which directly owns the Swiss company, and then that directly owns another BV investment company, another BV holding company, a Dutch company that holds another BV investment Dutch company.
I'm sorry, Mr. Makbul, for interrupting, but your time is 5 minutes left because we will
Okay.
have a full question after this. Thank you.
Okay, so here we got a lot of structures, and in the end, bottom is the green, the Southeast Asian company, where the problem might be that there are interest payments. The Dutch investment company has given loans to the Indonesian, the Southeast Asian company in green. And in return for this loan, they pay interest payment back up to the Dutch investment company, and similarly there are royalty payments and so forth. The issue is this Dutch company in the investment company a letterbox company? Could we make challenges on permanent establishments, on the foreigners, and run some substance tests? Because the way they're doing it, they're using treaty use, withholding taxes are virtually none from the interest payments, or there might be some very small amounts on interest, royalty fees and dividends. Dividends are paid to the US from the Dutch, where they have this beautiful treaty with the US, where they don't withhold any withholding tax on the dividends and so forth. So you have this nice little structure in between that will allow you to evade or shift profit to for the multinational and shift profit away from the Indonesian or the Southeast Asian structure. So these structures are there, and it can be found quite easily. So if you move to the next slide, possibly of illicit funding and tax evasion. I ran some algorithms on this a while ago to look at the to select the following scenarios. I put in non-transparent ownership structure, including sanctioned individuals, that in this variable there are nominees, officers of related offshore companies. So that's been put in, and I put in another variable, have exposure to nil or low tax jurisdictions or activities involving jurisdictions where financial centers are located, like Hong Kong and so forth. And they have special purpose vehicles indicated by the use of previously dormant companies, use of possible large financial transactions. The output in the example shows economic activity through a complex system of legal vehicles. The longer the chain of entities between legal vehicles and the jurisdictions entities span, the vehicles and the jurisdictions entities span, the harder it is to identify the beneficial owner, given the need to determine who controls each of the layer. So you can see the layers, layer 1, layer 2, and so forth. Also, where there are nominees involved, to identify the beneficial owners as nominee shareholders, which are proxies for someone else, hiding the real owners' names. However, with the ownership linking of direct and indirect ownership from global information aggregated, we could link quite meticulously and develop ownership structures. Thus, in this example, we could trace ownership from the sanctioned individual from the top down to the lowest level of economic activity, trading businesses across the globe, property investments, portfolios, and trading businesses. So data allows us to do this, to look at it very quickly. The fact of the matter is that such secretive entities have been used with trust, investments, asset holdings, special purpose vehicles, companies with nominees involved, and span companies across all tax jurisdictions, Virgin Island, Great Britain, the trust, that is the Channel Islands, Guernsey Trust, Cayman Islands, Bermuda, financial centers such as Hong Kong. There are many red flags here to indicate a real suspicious setup, especially when there are large inputs of funds that have been identified to a sanctioned individual. So you can see from the two model outputs how easy that is for us to do this, look at this. And just to wind up this quickly, I'll conclude with some key takeaways. If you'd show the next slide, please. So I can keep to the time. The key takeaways is that there is considerable data now in 2020 compared to 10 years ago at both tax jurisdiction and commercial providers level, that is Bureau of Indirect level. And we have increased our data from 2010 to 2020, some 800%. There is more data now to give visibility of location of entities in low tax jurisdictions and financial centers. There is more information on the nature of entities as to whether they are holdings, conduit, special purpose vehicles, non-permanent establishments, etc. The BAPS country by country reports there are potential high-level indicators of profit shift. Blending with commercial data and other third-party data, the CRS public disclosures, there are very strong red flags available to establish real legal challenges to tax avoidance and fraud. The development of framework for sharing knowledge, data, and implementing multilateral instruments has given the tax administrations tools to combat loss of tax away from their jurisdictions. The administrations need to make meaningful use of all the data and tools available nowadays. I've been preaching this for the last 20 years. The tax administrations need to ensure systems, IT infrastructures, and processes are in place to implement tax effective measures to recoup tax loss by limiting tax avoidance and tax evasion. So these are the conclusion to my presentation. Hopefully I've done it in time. And there'll be 3 poll questions which the team are going to put up. And if I read them out, I'll be grateful if you can complete those and we can then action those. There'll be 3 questions. The question 1 will be, how important is it to you to limit tax avoidance and evasion? Is it very important, fairly important, not important? Second question is, do you find the content of this presentation relevant to your work? Yes, or not really. And the question 3 is, would you like a free trial or a meeting with us to understand how our solutions for tax risks and transfer pricing can help you? Yes, not at the moment. So those are the 3 poll questions, and we'll be grateful really if you can complete these and let us have some feedback. Many thanks. Shukran. Thank you. So the questions are here. How important is it for you to limit tax avoidance and evasion? Very important, fairly important, not important. Second question, do you find the content of this presentation relevant to you, to your work? Yes, not really. Would you like a free trial or a meeting with us to understand how our solutions for tax risk and transfer pricing can help you? Yes, and not at the moment. So if you can fill that in and submit it, many thanks for your support. Thank you.
Okay, we have done our polling question. Now we would like to continue our next event. It's a panel discussion 4, but before I would like to kindly remind you that we will still have a closing remarks from the chairman of IAI KAPJ, so do not go anywhere and please stay with us. The panel discussion 4 topic is tax treaty and multilateral instrument, MLI. The speakers for this session is Mr. Adrian Munandar, Section Chief of International Taxation Treaties and Cooperation 3, Directorate of International Taxation DGT Indonesia. We also have Ms. Melanie Dwi Astuti, the Assistant Deputy Director Fiscal Policy Agency. And also we will have Mr. Sivakumar Sarafan, the Senior Tax Partner and Corporate Service Crow Singapore. For the moderator, we will have Ms. Ratna Febrina from SF Consulting, member of Crow Global. So we have all the panelists and the moderator here. But before, please, I would like to read the brief CV of Ms. Ratna Febrina. Ratna Febrina current position is a partner in SF Consulting. She has over 20 years of experience as a tax consultant with Arthur Andersen and Ernst & Young Indonesia before being a partner in SF Consulting. Prior to being a tax consultant, she was an auditor in Deloitte. So now we let Ms. Ratna Febrina to host the session.
Thank you, Nabila. The Honorable Mr. Pascal Amans, the Director of OECD, the Honorable Professor John Hutagao, Chairman of Indonesia Institute of Accountant of Tax Accountant Compartment, the Honorable Mr. Kisodial, Managing Director of Bureau Van Dijk, the Honorable Speakers, ladies and gentlemen. Assalamualaikum warahmatullahi wabarakatuh. Good afternoon. It is an honor for me to be a moderator in the 7th International Tax Conference events. The topic of this panel discussion is tax treaty and multilateral instrument. The multilateral instrument is a groundbreaking mechanism to update the network of thousands of bilateral tax treaties that make up the international tax system. It aims to reduce opportunities for multinational corporations to reduce their tax burden through base erosion and profit shifting. While the MLI was not designed primarily to address the priorities of developing countries in relation to the international tax system, it nevertheless offers a means to tackle practices such as treaty shopping and companies avoiding setting up taxable permanent establishment. The extent to which this potential is realized depends on the choices made by the developing countries and by their treaty partners, since changes are only operational if both parties choose compatible options. Today, we are lucky as we have a very competent speakers in this area from Indonesia Tax Authority, Fiscal Policy Agency, and from Singapore practitioner. It will be a little bit technical, but it will be interesting as MLI will be effective soon. The new Indonesia and Singapore tax treaty is also an interesting topic. As we know, Indonesia has a significant transaction with Singapore. As such, an insight from Singapore tax practitioner will be beneficial also for us. Before we start the discussion, let me introduce the panelists in this session. The first panelist is Pak Adrian Munandar. Pak Adrian, his current position is Head Section of International Taxation Treaties and Cooperation 3, Director International Taxation. Prior to this, he was Head Section in DGT Regional Office of Sumatra Selatan, Babel, and Staff in Directorate of Tax Regulation 2. He holds Associate Degree in 1995 and also Bachelor of Economics from University of Indonesia. And he continued his education in the University of Melbourne and obtained a master in the international taxation. The second speaker is Ibu Melanie Dwi Astuti. Ibu Melanie, her current position of Ibu Melanie is a senior tax treaty analyst in the Fiscal Policy Agency. Prior to this, she was an assistant deputy director for tax treaty at Fiscal Policy Agency. And she started her career at DGT Indonesia. She holds diploma from the State College of Accountancy and Master of International Taxation from University of Sydney. The third speaker will be Mr. Siva Kumar Saravan. Mr. Siva is a senior partner and head of tax at Crowe Singapore. He has about 25 years of experience in the tax. Siva has extensive experience in advising clients on international corporate and personal tax, implication of various cross-border transactions involving the countries in the Asia Pacific region. He holds a Bachelor of Accountancy degree from Nanyang Technological University, Singapore. The time allocation of this session will be like 75 minutes, and each panelist will have 15 minutes to make a presentation. So without further ado, I would like to invite our first panelist, Bapak Adrian. Pak Adrian, the time is yours.
Thank you, Ms. Ratna. Good afternoon, ladies and gentlemen. Assalamualaikum warahmatullahi wabarakatuh. First of all, I would like to express my gratitude and appreciation to all of you who has been joining on these 2 consecutive days of Virtual International Tax Conference 2020, current updates on international tax development, which is held by Institute of Indonesia Chartered Accountants, Tax Compartment, and Bureau Funding. I hope you are safe and healthy during this pandemic. It is my pleasure to participate in this panel discussion session 4 as a speaker on tax treaty and multilateral instrument, or MLI. In this opportunity, I will cover the general overview of MLI and the mechanism of MLI to modify tax treaties. Let's move further to the next slide. In international taxation, there have been many significant changes in the past several decades. The conclusion of, as we know that multilateral convention to implement tax treaty-related measure to prevent base erosion profit shifting, or known as MLI, multilateral instrument, marks a new turning point in tax treaty history. The text of MLI was developed through a negotiation involving more than 100 countries and jurisdictions, and adopted on November 24, 2016. Under a mandate delivered by G20 finance ministers and central bank governors at their February 2015 meeting. As already know, that the first sign of the MLI is on June 7, 2017, and over 70 ministers and other high-level representatives participated in the MLI signing ceremony, in which 67 countries signed the MLI. This multilateral instrument offers concrete solutions for government to close loopholes in international tax treaties by transposing results from the BEPS project into bilateral tax treaties worldwide. Additionally, the MLI allows governments to implement agreed minimum standards to counter treaty abuse and to improve dispute resolution mechanism while providing possibility to accommodate specific tax treaty policy. As of September 29, 2020, there are 94 jurisdictions that have signed the MLI. Meanwhile, there are also several jurisdictions such as Algeria, Eswatini, Lebanon, and Thailand, who who have expressed their intent to sign the convention. Next slide, please. Can we move to the next slide? There are also several countries from ASEAN, which is Indonesia, Malaysia, and Singapore also signed the MLI. And then Indonesia and Singapore have ratified and deposit to OECD as a secretary, but Malaysia hasn't ratified the MLI. Next slide, please. As outlined in the BEPS Action 15 report, the main objectives of a multilateral instrument would be to modify existing bilateral tax treaty in a synchronized and efficient manner to implement the tax treaty measures developed during the BEPS project without the need to expand resources individually, renegotiating each treaty bilaterally. Frankly speaking, the MLI bypasses the bilateral negotiation process required. The MLI bypasses the bilateral negotiation process required for every treaty, which typically takes a tremendous amount of time, energy, and other resources. As a result, the MLI doesn't apply to all of the existing tax treaties of its party, but only modifies covered tax agreement, which are defined as any treaty for the avoidance of double taxation with regards to taxes on income in force between two or more parties to the MLI, whether concluded before or after the MLI, provided that each of the parties has notified it as a treaty covered by the MLI. Consequently, if not all the parties to a tax treaty send a notification to the depository listing that the tax treaty as a CTA, it would not fall within the scope of the MLI. Next slide, please. In BEPS Action 15, actually there are 4 BEPS Action Plan, which are incorporated in BEPS Action 15. There is hybrid mismatches in BEPS Action 2, BEPS Action 6 about treaty abuse, BEPS Action 7 permanent establishment, and then BEPS Action 14 making dispute resolution mechanism more effective. Or we usually call it dispute resolution BEPS Action Plan. Next slide. This is the architecture of the MLI. In general, we can divide into 4 categories. For the scope and interpretation of terms, part 1, it's in Article 1 and 2. And for Article 3 to Article 17, deal with BEPS-related treaty measure, which I explained before. And then for Article 18 to 26, cover provision related to mandatory binding arbitration, part 6. And then Articles 27 to 39 contain procedural provisions such as provision relevant to adoption and implementation of the MLI, including ratification, entry into force, and entry into effect dates. We can move to the next slide. The articles of the MLI as I mentioned earlier, that the MLI doesn't apply to all of the existing tax treaties of its party, but only modifies CTA or cover text agreement. Therefore, each party to the MLI should have made a notification to the depository and listing the text treaty as a text treaty which it wishes to be covered by the MLI. Next stage of modifying is reservation and choice optional provisions. The MLI introduced a complex system of reservations in virtue of flexibility to implement BEPS text treaty measures in various ways. As explained in Article 28 of the MLI, the jurisdictions may choose to apply optional and alternative provisions and reservations to opt out of provision or parts of provision that are not minimum standards. Further, to safeguard clarity, transparency, certainty, and predictability of its application, the MLI requires parties to notify the depository of their choices and or significant information regarding the CTA. Finally, the MLI provisions will generally have affected to each party with respect to a CTA at a different moment with respect to taxes withheld at source and with respect to all other taxes levied by a party as explained in Article 35 of the MLI. Next slide, please. This slide is about the matching exercise. The process starts with the listed agreement on the left-hand side. Each country has this list of which countries they prefer to be included. So at the beginning, the countries choose countries they prefer to be included. And if there are two countries which both enter their treaty with their respective counterpart on the listed agreement, the cover text agreement then takes place. At this point, we can be sure that the articles on the minimum standards apply. What about other articles? It will be the match provision only if the cover text agreement, both countries also choose to adopt the same articles. The articles are other than those of the minimum standards. So it is there is an obligation to apply minimum standard when both countries have choose choose to be included in the MLI or categorized as cover text agreement. Next slide, please. To ensure clarity and transparency about the application of the convention, where a provision supersedes or modifies specific types of existing provision of CTA, parties are generally required to make notification specifying which CTA contain provisions to that type. The effect of notification varies depending on the type of compatibility clause that applies to the provision as follows. There are 4 compatibility clauses. Provision of the convention applies in place of. The first compatibility clause is in place of, describes that the provision are intended to replace an existing provision if one exists and is not intended to apply if an existing provision doesn't exist. The second compatibility clause is applies to or modifies, enables parties to change the application of an existing provision without replacing it, and therefore can only apply if there is an existing provision. The third is in the absence of. It will apply only in cases where all contracting jurisdictions notify the absence of an existing provision of the CTA. The fourth is in place of or in the absence of an existing. The provision of the convention applies in place of. Sorry, I repeat again. provision of the convention applies in place of or in the absence of an existing provision of a CTA will apply in all cases. Next slide. This is about MLI in Indonesia. On June 7, 2017, the government of Indonesia signed the multilateral instrument on tax treaty at the head office of the OECD in Paris. With other 68 countries, Minister of Finance Sri Mulyani Indrawati became the representative of government of Indonesia. Accordingly, the Indonesian government has issued Presidential Regulation number 77 year 2019 on November 12, 2019 and listing 47 bilateral tax treaties as the notification of the convention. Shortly after the ratification on April 28, 2020, Indonesia became the 45th country to deposit its instrument of ratification for the MLI. As consequence, this convention will enter into force in respect of Indonesia on August 1st, 2020. Shall we move to the next place? To the next slide. Okay. There are a number of factors as to why Indonesia agreed to sign the MLI in the first place. Firstly, MLI is part of the 15 BEPS Action Plan, a joint project of the OECD and G20 countries. As part of the G20 countries, Indonesia has shown its commitment to the OECD G20 BEPS project since the very beginning, including the MLI project. Secondly, by entering MLI's network, any country as well as Indonesia can adopt the minimum standard on BEPS Action Plan without having to amend tax treaties bilaterally, which requires a tremendous amount of resources. Last but not least, this will then result in a new state where profits are taxed according to appropriate economic activities performed and also improve certainty for business by better handling international tax-related disputes and standardizing compliance requirements. Next slide. This is Indonesia Tax Treaties Network. Indonesia has signed DTS with many countries. As we can see in the slide, there are 71 tax treaty network, and Cambodia is the last countries that ratify in the treaty has been ratified in July 2020. With a broad treaty network in place, Indonesia is having quite the opportunity where MLI could be the instrument to improve the current system. Next slide. This is the Indonesia's MLI position. On the left side, we can see that there are 3 minimum standards provision, which come from the BEPS Action 6, purpose of a covered tax agreement, and then, Article 6, purpose of a covered tax agreement on the convention, and then Article 7, prevention of treaty abuse, Article 16, mutual agreement procedure. And then beside the minimum standards, Indonesia also opt in 9 non-minimum standard. The non-minimum standard on the side is on the right side. There are Article 4, article about dual resident entities, Article 8, dividend transfer transaction, Article 9, capital gains from the alienation of shares and interests of entities deriving their value principally from immovable property, Article 11, application of tax agreement to restrict a party's right to tax its own resident, Article 12, artificial avoidance of permanent establishment status through commissioner arrangement and similar strategies, Article 13, artificial avoidance of permanent establishment status through the specific activity exemption, option A, Article 14, splitting up contracts. Article 15, definition of a person closely related to enterprise. And Article 17, regarding the corresponding adjustment. Next slide. This slide tells about the OECD matching database. Here we can see that from the 47 that Indonesia chose to modify tax treaties, there are 38 countries has chosen Indonesia as the MLS partner. Next slide. This is 22 country that has been ratified their MLI, and they already deposit the ratification to the to OECD. So out of 38, 22 countries have ratified the MLI in their respective countries. These are the 20 countries that have ratified their MLI. You can see the last countries have ratified and deposit to OECD is Korea. Next slide. Speaking of the latter opportunity we can get with MLI is that Indonesia could add more countries as MLI partners, as well as add more articles adopted in MLI. However, after ratification, the opposite way, which reduce the number of countries or adopted articles, might not seem feasible. Finally, MLI hopefully could swiftly and effectively alleviate challenges that have faced by incorporating multilateral approach. And now I'm about to end this presentation, and I will return the floor to moderator. Ms. Ratna, thank you.
Yeah, thank you, Pak Adrian, for the presentation. Pak Adrian shares from his presentation on the MLI structure and how MLI works, including matching exercise, and then minimum syarat provision should be applied. Other provisions shall apply if both countries opt in the provision. And then Indonesia has opt-in 12 provision of MLI. Also the development of MLI in Indonesia. Now it's time for the second panelist, Ibu Melanie Dewi Astuti. So Ibu Melanie, the time is yours, Ibu Melanie.
Thank you, Ms. Ratna. Assalamualaikum warahmatullahi wabarakatuh. Am I audible? Okay. I will continue the presentation by Pak Adrian because I have lots of materials, 12 provision I have to explain. So I will start directly. Okay, slide number 3. Directly to slide number 3. Next, okay. I will start with the minimum standard article, as has been mentioned by Pak Adrian, Article 6, 7, and 16. Article 6 is relevant to the preamble of the DTA. As you can see, the letter written in red, that's the additional made by MLI. It is intended to clarify that the objective of the tax treaty, it's not only to prevent double tax evasion and tax avoidance, but also double non-taxation as a result of tax avoidance and tax evasion. I think it is pretty clear. Now I'll move to the next slide. Next slide. Article 7 is similar to Article 6. I'm sorry, next slide. Yeah. Article 7 is also related to anti-treaty abuse provision. Indonesia adopted principal purpose test. This is a new provision. We don't find PPT in the current DTA. But you can see similar provision in some of our treaties. Our treaty with Hong Kong, UK, Serbia, Mexico, and India has this similar provision, which is so-called mini PPT. The difference between both, mini PPT is normally only applicable to the certain provision within the DTA. Specifically, Article 10 dividend, 11 interest, and 12 royalty. On the other hand, PPT will be applicable for the whole provision within the DTA, not limited to the certain provision within the DTA. Then the Article 7 MLI PPT will be added to the DTA or replace the mini PPT. Okay, next slide. I will go further on PPT because this is the most important article in the MLI. Next slide, please. We can read PPT in a simple way. The treaty benefit shall not be granted, first, where it is reasonable to conclude that obtaining the benefit was one of the principal purposes of the arrangement. And second, unless it is established that granting that benefit would be in accordance with the object and purpose of the relevant provision of the treaty. I will give you an example. Let's say Company A owns 20% of shares in Company B in country B. Then one day before the distribution of dividend, Company A adds additional capital 5%. So the ownership is now 25%. Based on country B and country A DTA, there are two rates of dividend. 5% for 25% minimum ownership, 5% rate for 25 minimum ownership, 10% for less than 25% ownership. What do you think? At the time the distribution of dividend, will the lower rate be granted? Let's check the MLI, the PPT. First, is it reasonable to conclude that obtaining treaty benefit is one of the principal purpose of such arrangement? It is reasonably yes. But in the second step, is granting that benefit would still be in accordance with the object and purpose of the relevant provision within the DTA? Well, let's see. Article 10, paragraph 2 has two layers of rate. What do you think the objective? Because it's aimed to attract more FDI by having a lower rate rather than portfolio. So once the threshold is achieved, 25%, the lower rate shall be given. And giving this benefit will still be in accordance with the object and purpose of 10 paragraph 2 to attract more benefit. But if the Article 8 of the MLI apply, it might be a different case. I will explain later. PPT also have some features. The first is benefit under DTA. What is benefit? Benefit may cover very broad. It can cover tax reduction, tax exemption, refund, relief from double tax, PE exemption, and others. And facts and circumstances. It's not always based on taxpayer intention. For example, if I ask you, what is your intention of making such arrangement? I'm sure you will answer, well, obtaining treaty benefit is not one of our principal purpose on making such arrangement. I'm sure about that. That's why facts and circumstances is not based on the taxpayer intention. It's based on facts, condition. It's not always based on legal documents, not always have to be written documents, as long as it is reasonable to conclude that obtaining the treaty benefit is one of the principal purpose. And what is meant by one of principal purpose? Maybe my colleague Shiva will explain more detail. I just want to add principal purpose similar to main purpose, but it doesn't have to be the only principal purpose. It doesn't have the sole or dominant purpose. It could be several main purposes in which obtaining treaty benefit is one of them. And what is arrangement? Arrangement also be defined broadly. It can cover agreements, understanding, scheme, transaction, or series of transactions. The tax administration may look at one single transaction or series of a transaction because it's stated directly, indirectly. It is normal for a series have a final objective. The final objective is business purpose, but one or two of the transaction within that series could be to obtain treaty benefit. In this regard, the tax administration may deny the benefit. And then the last, onus of proof. In general, the burden of proof is on the taxpayer. Okay, next. I will stop with PPT. I will continue with the last minimum standard article, Article 16, regarding MAP. There are two major changes related to this. The first is the duration of applying an MAP, which is now 33 years based on MLI. The current DTA could be 2 years, 3 years, or not specifically mentioned. The other change, the significant change, is related to the implementation of MAP result. As Bu Ewi earlier mentioned, the MAP result shall be implemented notwithstanding any limit in the domestic law. I know that you know that we have some of our treaties with that provision, but not all. That's why Article 16 MLI is intended to put this in the DTA to give more certainty to the taxpayer. Okay, next. Now I'll go to non-minimum standard. Next, we start with Article 4, resident. Article 4 just made changes to the dual resident problem for corporate, not the individual. The current DTA solved the dual resident problem for corporate by relying on place of effective management. But the MLI resolved such problem through MAP, through dispute resolution. However, place of effective management could be one factor to be considered in the MAP discussion. Do you think why? Because it is easy to move place of effective management from one country to another country. Just by moving the main shareholders, the board of directors, or moving the strategic meeting. So the place of effective management will be moved to another country. Maybe we'll go to the next slide. I have a case. I know you've already all familiar with this. Next, it's Google case. The one that I circle in red is a step. This is a series of transactions, what I mean before, but one of the steps is related to the definition of resident. It's circumventing the different definition of resident among countries. Google established an entity in Ireland, company A. It was incorporated in Ireland, but the place of effective management was in Bermuda. Based on the definition of resident in Ireland, resident of Ireland is where the place of effective management is situated. While if the definition of resident in Bermuda is where the place of incorporation is, so what do you think? Company A will be stateless. He is not resident in Ireland nor in Bermuda. And the consequence, his income will be taxed nowhere, not in Ireland, not in Bermuda. I think it's pretty clear now. I will move to Article 8. Next. Next, Article 8. Yeah, this is anti-dividend stripping. Do you remember the case that I mentioned before, Company A and Company B? This is what I mean. This article will prevent such planning. If this article apply, Company A will not be granted lower rate of dividend. Why? Because this article will add 365 days period as a threshold. So if the capital, so to get a lower rate, the capital should be owned at a minimum 365 days before the dividend distributed. And the day when the dividend distributed will be counted. So the previous case, lower rate will not be granted. Okay, next, Article 9. Next, I have explained before. Next, Article 9 is related to capital gain, especially 13 paragraph 4 of the DTA, indirect transfer of asset, which is a transfer of shares, which is actually a transfer of immovable property, provided that the total asset of the company whose shares are transferred, minimum 50% is immovable property. This article aims to prevent the taxpayer by lowering the amount of immovable property to avoid the 50% threshold, because once the threshold is achieved, the source country, the country where the immovable property is situated, will have the taxing right on capital gain. This Article 9 will add 365 days period, similar to the dividend before, but implemented in different way. So if during such period, 365 days, the immovable property average 50% at a time, it could be 1 minute maybe, it's too extreme I think, 1 hour, 1 day, 1 month, it could average 50%, even though at the day when the shares transferred, the immovable property is lower than 50%, the source country will have the taxing right. Okay, I think it's clear. We can move. We can move to Article 11. This article just intended to clarify that a contracting state has its right to tax its own resident, but still giving the treaty benefit related to article as mentioned here, article corresponding adjustment, government service, and etc. Therefore, the application of CFC rules, tin capitalization rules, will not have any conflict with the DTA. Sorry, I think it's dark. Okay. Next slide. We go to article related to permanent establishment, which are Article 12 to Article 15. First, Article 12, commissioner arrangement. I will explain with the case study. Next. I have a case study after this. Next slide. Yeah, I know that you may be already familiar with this. This is Dell case. It's a case about commissioner arrangement. The Dell US manufactured the computers, and then Dell Ireland distributes the computers. But in here, Dell Ireland has a commissioner arrangement with Dell Norway, in which Dell Norway will receive commission for sales to European customers. The contract signed by Dell Ireland. Dell Norway doesn't have title of good. What do you think? Is there any PE of Dell Ireland in Dell Norway? Let's see. Based on the current DTA, a person is regarded as dependent agent if he has the habitually to conclude contract. In this case, the contract is signed by Del Ireland. So there will be no PE in Norway based on the current DTA, and that's what the judge decided. But by MLI, with MLI, a person doesn't have to have an authority to conclude contract to be regarded as a dependent agent. As long as he plays the principal role that leading to a conclusion of a contract, he still can be a dependent agent. So if Del Norway plays the principal role that concluding to a contract, for example, he offers the product, he negotiates with the customers, then he communicates, but he doesn't sign, he can be regarded as having a principal role. So in this regard, Del Ireland could have a PE in Norway based on MLI. Okay, next. I will go to Article 13. It's about specific activity exemption. As you see, sorry, it's very small. In the left side is the activities listed in the current DTA that are regarded preparatory and auxiliary. For example, the maintenance of a facility to do display, storage, the maintenance of stock for processing by another entity, collecting information, advertising, and etc. Those activities are regarded as preparatory and auxiliary and will not trigger a PE. While in the right side, that's the changes made by MLI. It's not based on the type of the activity, unlike in the current DTA, it's based on the nature. I will explain it with example. Next slide. Next slide. Yeah, this is just an example. It's not based on a real case. Let's say Reuters. He operates in the business of news provider. Reuters has an entity in Singapore and in Indonesia. The Indonesian entity has to collect information from Indonesia and then forward the information to Singapore. Do you think Singapore entity will have a PE in Indonesia? Based on the current DTA, collecting information is one activity that regarded as preparatory and auxiliary. But in the MLI, we don't see it like that. The business of news provider, collecting information is essential activity. It's related to the core business, to the core activities of the business. Therefore, in this case, Singapore will have a PE in Indonesia. Now, I hope you know the difference. Okay, next slide. Now we go to Article 14. It's anti-splitting contract relevant to construction. It is intended to prevent the taxpayer from splitting up the contract to be a shorter period to avoid the time test for PE construction. The Article 14 of the MLI will aggregate the time spent by some activities in a jurisdiction related to connected projects conducted by closely related person. I will explain later, provided that each activity spends more than 30 days and below the time test. If this what happened, the Article 14 MLI will aggregate all the time spent by each activity. Okay, I think that's Article 14, and now we go to Article 15, the closely related person. Next. Next again, yeah, closely related person. This is the new provision, but this provision is similar to Article 18, paragraph 4, definition of related party. The difference is the threshold in Article 18, paragraph 4 is 25%, while in here, the threshold is 50%. But this article only applicable to PE provision. It's not applicable for other provisions. Yeah, I think that's all about PE. Now I'll go to the last article of the MLI. Article 17, corresponding adjustment. Next. Article 17 of the MLI just want to add 9 paragraph 2 of the DTA corresponding adjustment to the DTA because not all DTAs have 9 paragraph 2. By having this article doesn't mean that corresponding adjustment shall be given automatically. A contracting state could provide corresponding adjustment if the adjustment is considered if the country considered that the adjustment could be justified in principle and in amount. So it's not mathematically. There are lots of questions about that. Okay, I think I have covered all the articles of the MLI that adopted by Indonesia, but I still have one slide that is very popular. A lot of questions about this. Next, about the interaction between MLI and the new DTA between Indonesia and Singapore. Yeah, this is the last slide, I promise. As you can see, the MLI, Pak Adrian has mentioned, is entered into force on August 2020 and will enter into effect on 1st January 2021 for withholding tax and 1st January 2022 for other taxes. So the MLI will modify the current DTA based on the Vienna Convention, Article 30, Paragraph 3. In this case, in this regard, the MLI is the later treaty. The existing DTA is the earlier treaty. Because the MLI doesn't terminate the current DTA, the other provisions of the current DTA that are not modified by MLI will still be applicable. What about the new DTA? The new DTA has been signed, but it's still in the ratification process. Let's say if it is effective on 1 January 2022, the MLI will not modify the new DTA because the new DTA is the later treaty. The MLI will be the earlier treaty. Luckily, all the MLI match provision between Indonesia and Singapore have been put in the new DTA, the minimum standard articles and corresponding adjustment. Therefore, there will be any conflict between MLI and the new DTA, at least for now. As Pak Adrian mentioned, both countries could still change its position on MLI, forward changes, not backward changes. I think that's all from me. Thank you. I'm sorry if I'm a little rushing because I have lots of material to be covered. Thank you.
Thank you, Ibu Melanie. It is a very interesting presentation. So Ibu Melanie has elaborated more on the 12 MLI provision that Indonesia opt-in. On the standard MLI, Ibu Melanie explaining on the PPT concept, and then on the MAP, now there is a certainty of 3 years limitation to conclude the MAP. And then for the non-standard provision, Ibu Melanie provide also an example for the application of paragraph 4, which is the Google case, and then paragraph provision article 12 for the Dell case, and also for the Reuters case. So it will make more clearer for us. Thank you, Bu Melanie. So without the example, we see it's so complicated, but it's more clearer now. So we go to our last panelist, Mr. Siva Sarafan. Siva, the time is yours, Siva.
Thank you, Ibu Ratna. Good afternoon, everyone. Now, I just want to check before I carry on whether my slides have been loaded. And the slides are still not up yet. Okay, I'm going to present on the Singapore's MLI position and explore the new tax treaty between Indonesia and Singapore. Now, given that we are running a little bit late, I may want to skip through some of the slides. So can I go to the next slide, please? Next slide again. I'm going to skip through this introduction. Next slide. Sorry, slide back again. Okay, so I just want to provide the Singapore's MLI progress timeline. So Singapore joined the Inclusive Framework on BEPS as a BEPS associate in June 2016. Singapore deposited the instrument of ratification on 21st December 2018 and identified 86 tax treaties for the MLI to apply. And the MLI entered into force for Singapore on 1st April 2019. Now, as of 1st October 2020, 38 tax treaties have been amended so far. Next slide, please. Now, before I discuss Singapore's MLI position, I just want to mention that the MLI provides certain level of flexibility. There are mandatory provisions pertaining to the BEPS minimum standards that all parties to the MLI are required to adopt unless the country's covered tax agreements already meet the minimum standards. Then there are non-mandatory provisions which countries can either opt in or opt out totally or partially. Next slide, please. Now, this slide and the next slide would actually show the Singapore's MLI position for Articles 3 to 26. As you can see, Singapore has basically adopted the mandatory provisions in the MLI, which are Article 6, Article 7, and Article 16. Next slide, please. Singapore has also adopted a number of non-mandatory provisions. The emphasis is on improving dispute resolution. As you can see, by opting in to the mandatory binding arbitration provisions, an alternative mechanism has been provided to taxpayers, which will basically help in settling any unresolved MAP cases. However, there are some limitations though. For example, cases that are subject to Singapore's domestic general anti-avoidance rules will not be eligible for arbitration. Next slide, please. Now I'd like to do a comparison between the MLI positions of Indonesia and Singapore. Next slide. Now, given that the DTA between Indonesia and Singapore will be amended by an MLI provision only if both the countries have taken the same position, the text in red highlights the common positions. You can see that the changes to the text treaty will mainly be related to the BEPS minimum standards, which are Article 6, Article 7, and Article 16, which is in the next slide. Okay. In addition, there are a few non-mandatory MLI provisions that both countries have opted in as well, such as Article 13 and Article 15. Next slide, please. Next slide. And as you can see here, while Singapore has opted in for arbitration, Indonesia has opted out. As one of the earlier speakers has mentioned that arbitration is not provided for under the domestic law. Okay, next slide, please. Next, I would like to look at the new Indonesia-Singapore Tax Treaty. Next slide. The treaty was signed on 4th of February 2020. It has not been ratified by Singapore as of today, and therefore it is not in force yet. Now, the new treaty actually incorporates the MLI provisions. And what I want to do next is to look at some of these provisions and provide some comments and observations. Okay, next slide, please. Next slide. First, let's look at Article 7 of the MLI. As I mentioned earlier, the PPT is a minimum standard. I think that it is probably the most significant amendment incorporated into the tax treaty. The PPT rule as enshrined in Article 28 of the new tax treaty basically provides an added ammunition to the tax authorities to counter treaty shopping. Now, the earlier speaker, Ibu Melani, discussed the PPT rule in detail, so I shall not elaborate here. Just one observation, though, that the discretionary relief provision, as provided for in Article 7, paragraph 4 of the MLI, is not in the treaty. Now, basically, the discretionary provision would have given the tax authorities of both countries to grant treaty benefits to a taxpayer upon request, even though the taxpayer failed the PPT test. So given that, that provision is not here, it would seem that, if the taxpayer fails the PPT test, basically there's no provision for them to actually, in a way, appeal to the tax authorities. Next slide, please. Now, the PPT is not new to Singapore. It was already present in different forms in Singapore's tax treaties, as well in the domestic law. Now, Singapore's position all along is that it does not condone treaty shopping. It also does not condone any activities aimed at base erosion and profit shifting. Now, as you can see in this slide, just a couple of examples in terms of current anti-avoidance provisions that are in the various articles in various tax treaties. Next slide, please. Now, the PPT clause in Article 28 of the new tax treaty is likely to come into prominence, given that the new treaty further reduces the withholding tax on royalty, rental, and know-how. Now, the question is, how will PPT interact with existing anti-avoidance provisions in the tax treaty? For example, the dividend interest and royalty articles have the beneficial ownership requirement. The beneficial ownership rules are provided for in the domestic law. So let's say we have company C in Indonesia, and we have company B in Singapore. Now, in this situation, the beneficial ownership rules as per under Indonesia's domestic law needs to be satisfied. And company B also needs to prove that it is a resident of Singapore. Now, the Singapore tax authorities will only grant a certificate of residence to company B if company B has substance, right? So if it's just a pure conduit company, it is not going to get the certificate of residence. So in this case, given that, there's already this existing provision, then the question is, what is the role of PPT, or what's the impact of PPT? Now, when we look at the provision in Article 28 of the new tax treaty, it basically says that notwithstanding other provisions. So what it means is that PPT basically applies on top of the existing provisions. So it doesn't mean that because there are already existing provisions like beneficial ownership, PPT will not be effective. So it's an additional layer. And, if you recall, basically what PPT is, focused on is the objective of the transaction, right? And also the substance requirements. So from that perspective, the PPT basically fills the gaps in the current anti-avoidance provisions. So for example, beneficial ownership requirements may not actually deal with substance or may not deal with the objective of the transaction. So in this case, PPT is basically filling in the gaps. Of course, from a taxpayer perspective, that would be an additional requirement on top of what is already there in terms of beneficial ownership and residency test. Next slide, please. Now, next, I just want to make a comment on the improving dispute resolution. Next slide. And I want to basically focus on the corresponding adjustments, which I think is another important amendment in the new tax treaty, which basically would allow taxpayers in Singapore or in Indonesia to claim a corresponding adjustment if a TP adjustment had been made in Singapore or Indonesia respectively. Now, the positive aspect of this new clause in the treaty is that if the authorities agree, right? If the authorities agree on the TP adjustment, as you can see in the clause, it does say that the competent authorities of the contracting state, shall basically consult each other, right? So if they agree on the TP adjustment, then the taxpayer need not go through the MAP process to avoid double taxation. So I think from that perspective, I feel that this is a good development as far as the new tax treaty is concerned. Okay, next slide, please. Now, I just want to touch a little bit on the artificial avoidance of PE status, and this would be my last subtopic. Now, given the time that we have, I'm going to basically focus on Article 13 of the MLI. Also, if you look at Article 12 and Article 14 of the MLI, Singapore has basically opted out, right? Because of that, then Article 12 and 14 will not have an effect on the tax treaty. Okay, so I'm just going to look at Article 13. Now, before looking at whether there are any treaty changes in respect of Article 13, to the new tax treaty between Indonesia and Singapore, I want to cover the changes made to Article 5.4 of the OECD model. Next slide, please. Now, Article 5.4 relates to exceptions to the PE definition. Now, in BEPS Action Plan 7, it was stated that while the exceptions in Article 5.4 should be considered to be of a preparatory or auxiliary in nature, in the digital economy, what used to be preparatory or auxiliary in nature may now be the core business activities. Therefore, Article 5.4 has to be modified to ensure that each of the exceptions in Article 5.4 are restricted to activities that are preparatory or auxiliary in character. And if you look at the OECD commentary, it brings forth the idea of core business activities. That is, in considering whether an activity is preparatory or auxiliary in nature, we need to consider whether it forms an essential and significant part of the enterprise as a whole. Next slide, please. In addition, a new anti-fragmentation rule has been introduced. Basically, this addresses the issue whereby multinational companies can fragment their operations into several small activities to ensure that each part is considered preparatory or auxiliary in nature to benefit from the PE exceptions under Article 5.4. Now, under the anti-fragmentation rule, activities carried on by an enterprise at different places in the jurisdiction, as well as activities undertaken by its related companies or related parties in that jurisdiction, are taken into account to see if on the whole, the activities undertaken are preparatory or auxiliary in nature. So basically, you know, they're essentially like two rules, right? So next slide. So first question would be, do the activities form an essential and significant part of the activity of the enterprise as a whole? If yes, the exceptions under Article 5.4 may not apply. The second question would be, are the activities preparatory or auxiliary in nature, taking into account all the other activities carried on by the same enterprise or its related enterprises that constitute complementary functions that are part of a cohesive business operation? So the question is, are they actually fragmenting it, right? So if the answer is no to this question, then the exceptions under Article 5.4 will also not apply. Next slide, please. Now let's look at an example. In this case, ordinarily, it may be possible for company A to use Article 5.4, paragraph A and B, to argue that it has no PE in country S. However, with the changes to Article 5.4, the question now is whether the function of delivering the goods is a core function. Now, it may be possible for the delivery functions to be a core function if, for example, the timely delivery of goods to customers is its fundamental value proposition, and it invests significant resources and people in managing the storage and delivery of the goods. Next slide, please.
Sorry, Shiva, you only have 5 minutes remaining to finish.
All right. Okay, very good. I have to rush. Coming back to the Indonesia-Singapore Tax Treaty, although both countries opted into Article 13, you know, as you can see, basically they opted for different options. So Indonesia option A, Singapore option B, and because of that, what has happened is that next slide. Next slide, please. You find that basically there are no changes to the P exceptions in Article 5.3 of the tax treaty. So if you look at, you know, the previous article as well as the new article, you know, there are no changes. Okay, even though, you know, both countries have opted into Article 13. Okay. Now the question is, you know, does it mean that the issues we discussed earlier in relation to Article 5.4 of the OECD model is not applicable? Now, the thing to note is that when we look at exceptions A and B under OECD model convention, and if we look at it under Indonesia and Singapore tax treaty, you'll find that under Indonesia-Singapore tax treaty, the word delivery is missing, right? Which means that delivery or delivery activities are not considered as preparatory or auxiliary. Next slide. So going back to the earlier example, in the case of Indonesia-Singapore tax treaty, the delivery activities cannot be said to fall under the exception, right? And next slide. And in addition, paragraph 5 of Article 5 of the treaty provides that a PE will exist if an enterprise has a dependent agent who habitually maintains and regularly delivers goods or merchandise on behalf of the enterprise. So this somewhat also restricts the delivery activities to be exempted from the PE definition. Now, the point I want to make, considering Article 5.3 of the Indonesia Tax Treaty, is that although the provisions under Article 13, option A, has not been incorporated in the tax treaty, the existing and the new tax treaty somewhat already restricts certain e-commerce activities from going under the PE exceptions under Article 5.3. Next slide, please. However, when we look at procurement activities, which is another important activities by e-commerce companies, and of course, e-commerce is getting more and more popular, so it's something that to look at carefully. So when we look at procurement activities, it appears that the new tax treaty between Indonesia and Singapore will not affect the procurement activity being considered as not falling within the exceptions to the PE definition. So if we apply the revised OECD model convention, right, and the commentary, if the procurement activity is a core function, right, then the PE exception cannot be used. Okay. Now, in e-commerce situations where all transactions are online, it is possible that procurement is a vital function that contributes to the success of the online enterprise. So from that perspective, right, if you look at Article 13 MLI option A, and the changes made to OECD model convention and changes made to the model, commentary, in a situation like this, it is possible that the procurement activity could be considered as a permanent establishment, taking into account other factors. However, when we look at the new Indonesia and Singapore tax treaty, it has not been modified, right? It's not modified for Article 13 of the MLI. And therefore, the procurement activity alone should not unduly create a taxable presence, all other things being equal. So this brings to the end of my presentation, and I shall pass the floor back to Ibu Ratna. Thank you very much.
Okay, thank you, Siva, for your presentation. From the Siva presentation that Siva has sharing about the Singapore position towards MLI, and then comparison of the Singapore and Indonesia position on MLI, the changes in the new Indonesia-Singapore tax treaty, which is among others the inclusion of Article 7 PPT of MLI in the Article 28 of the new treaty, and then the inclusion of Article 16 and 17 of MLI in Article 9 of the new treaty. And also Siva provide the sample of cases of e-commerce in connection of the PE. So although this is a very interesting topic, considering that we have running time, I have to end the session. It's already 5:30. So I would like to say thanks again to the panelists for the informative and interesting talk. Hopefully the session will be beneficial for everybody. Thank you for your attention. Stay healthy. With the end of the session, I hand it over to Ibu Nabila Monica, the MC. Thank you.
Thank you, Ibu Ratna Febrina, for the panelists and the moderator for the session. Could you please turn on the video because we will have a group picture. Okay, are you ready? And all smile. Thank you very much, ladies and gentlemen, for the valuable insight regarding the tax treaty and multilateral instrument. And for ladies and gentlemen, participant of IAI KAPJ International Tax 2020. Thank you for staying with us. And now, before we end our 2 days conference, we would like to invite Mr. Professor John Hutagaul, the chairman of IAI KAPJ, who also the director of International Taxation DGT Indonesia, to deliver the closing remarks. Professor John Hutagaul, the floor is yours.
Thank you. Hi, Siva. Nice to meet you again. Okay. Now we all arrive at the end of this today's conference that have discussed the current updates on international taxation development. My dear colleague, Mr. Kiso Dial, Managing Director Bureau Van Dijk, Mr. Pascal San Aman, Director CTPA of the OECD, all speakers and moderators, thank you very much for your excellent presentation and arranging the panel. And also, ladies and gentlemen, Assalamualaikum warahmatullahi wabarakatuh. Greeting for all of us. Om Swastiastu, Nama Budaya, greetings of benevolence, and a very good afternoon to you all. My profound gratitude to God, the Almighty, for His wonderful grace and abundant blessing bestowed upon us to have His virtual conference. I would like to thank my colleague from the Institute of Indonesian Chartered Accountants, Tax Accountants Compartment, and Bureau Van Dijk as the co-host for this wonderful conference. I would also like to extend my appreciation to Pascal San Aman for sparing his time to join us despite his superbly tight schedule. As you know, Pascal is responsible for the coming the inclusive framework on BEPS started tomorrow until Friday. I'm glad that virtual conference has provided the participants with productive discussion and useful insight. At the panel discussion 1, we have been presented with a number of policy taken by government of Japan, Indonesia, Australia, People's Republic of China for dealing with the COVID-19 pandemic with the intention of maintaining their business operation, the purchasing power, and assisting our medical effort. In order to ease the burden of taxpayers fulfilling their tax obligation, it is also granted tax relaxation such as extension. At the panel discussion 2, we have discussed recent development in taxation on digital economy, including Pillar 1 and Pillar 2 that are being discussed in the inclusive framework on BEPS and what's Indonesian position is to the two pillars. At the panel discussion 3, we have discussed updates in transfer pricing and dispute settlement both in international fora and Indonesia domestic regulation. As Indonesian commitment to international best practice based on the BEPS Action 14 deliverable, Ministry of Finance regulation related to MAP and APA has been issued, namely Ministry of Finance Regulation number 49 year 2019 concerning MAP, and then Minister of Finance Regulation number 22 year concerning APA. At the panel discussion 4, we have been presented with the topic of the multilateral instrument that we have seen before and what Indonesian position are to each the article in the convention. Ladies and gentlemen, international taxation is playing a crucial role this time as the commercial activities have been carried out on without regard to jurisdictional borders and through the advancement of the technology. Those activities do not even possess any physical form. We are nowadays living in digital economy where the business could be conducted without limited by time and space. There are three characteristics in digital economy, namely mass without scale, reliance on intellectual property, data mining, and user participation. Ladies and gentlemen, the significance of international taxation has grown even bigger when we consider the rising importance of international cooperation in tax matters. Accountants, especially tax accountants, need to stay updated with the international taxation issue that have been going on, and I hope this virtual conference can be answered for that demand. I would also like to mention in particular the important role Indonesia has been playing in international taxation fora, having always been leading fellow developing countries to relay our views at every possible opportunity, including the 10th meeting of the Inclusive Framework on BEPS, which will be held virtually tomorrow, led by Mr. Sain Aman. Ladies and gentlemen, at the end of my speech, I would like to thank again all parties involved in preparing this virtual conference. First, to Mr. Mardiasmo, President of Institute of Indonesia Chartered Accountant, Bapak Yon Arsal, Senior Advisor to Minister of Finance for Tax Compliance, Bapak Heru Pamudi, Bapak Janurindo Wibowo, and Bapak Agus Arianto from Directorate General of Custom and Excise, Ibu Dwi Astuti, Satrio Adi Wibowo, Adrian Munandar, Arnold Purba from the Directorate General of Taxes, Melanie Dwi Astuti from the Fiscal Policy Agency, Permana Adi Saputra, and my colleague from the Institutes of Indonesia Chartered Accountants, Tax Accountants Compartment, Mr. Kiso Dial, Luis Carrillo, Makbul Laji from Bureau Van Dijk as the co-host, Pascal San Aman and Mr. Andrew Albach from the OECD, Rico Uda, Mr. Cam Smith, Jerry Jiang Wong, and Mr. Rock Kiantong from Deloitte, Mr. Sivakumar Sarafan, my friend, and Ibu Ratna Febrina from Crow, and Bapak Dani Septriadi from Dani Darussalam Tax Center, and Ibu Kristen Chen from the University of Indonesia. I hope we can have another conference discussing international taxation next year in a much better situation, so we can meet again face to face in the next conference as we used to do in the past. Again, thank you, and I wish you all perfect good health. Keep safe. Thank you very much. See you around. Bye.
Thank you, Professor John Hutagaul, for the closing remarks. Ladies and gentlemen, to obtain the presentation material of our today's conference, could you please help us in give the feedback by clicking the link on your screen? Then you can have all the presentation materials. Once again, on behalf of the organizing committee, we would like to express our sincere gratitude to our co-host, Bureau Van Dijk, a Moody's Analytics company, all the distinguished speakers, moderators, honorable guests, and participants. This event won't be conducted well without your great support. Thank you for your kind participation in today's. I'm Monica Nabilia. Thank you. Stay safe, stay home, stay healthy. Do not forget your mask. Good evening, and I'll see you again soon.
Iso, see you.
Terima kasih.
Terima kasih.
Terima kasih.
Pak Bul, terima kasih. Sivakumar, see you in Singapore next.
Yes, yes. We'll see you again. Hopefully.
Terima kasih, Pak.
Edward, Bu Melani,
Terima kasih,
Bu Febrina.
Ya, Pak. Terima kasih, Pak.
Bye-bye. Keep safe all. Bye-bye.
Thank you, Pak. Bye.
Bye.
Thank you.
Okay.
Ikatan Akuntan Indonesia, akuntan profesional unggul, Indonesia maju. Ikatan Akuntan Indonesia (IAI) telah berkiprah mendukung pembangunan SDM dan transformasi ekonomi Indonesia.
Akuntan memiliki peran penting dalam pembangunan nasional yang berkesinambungan.
Profesi akuntan mendukung upaya peningkatan profesionalisme SDM Indonesia agar bisa optimal berkarya mendukung pembangunan ekonomi yang efisien dan transparan. Melalui Prakarsa 6.1 yang telah ditetapkan sebagai program umum Dewan Pengurus Nasional IAI periode 2018-2022, IAI siap berkarya mengawal perekonomian bangsa ini menuju Indonesia Emas 2045.
Saya sangat mendukung rencana IAI untuk mempercepat program sertifikasi agar para akuntan di negara kita memiliki kreativitas, inovasi, keterampilan, dan memiliki daya saing, dan sekali lagi dalam rangka mendukung pengembangan ekosistem kita yang lebih akuntabel, lebih efisien, goal-oriented, dan inovatif.
Tanggung jawab itu terwujud melalui Chartered Accountant Indonesia sebagai identitas akuntan profesional Indonesia dan telah mendapat pengakuan kualitas secara global. Prakarsa 6.1 berisi 6 langkah aksi dengan satu tujuan strategis untuk memperkuat peran IAI dalam meningkatkan kepercayaan masyarakat terhadap entitas bisnis dan publik dengan menyiapkan akuntan profesional berintegritas siap menghadapi masa depan. IAI melaksanakan tugas dan tanggung jawabnya menyusun standar akuntansi keuangan dan standar profesi, melaksanakan ujian sertifikasi, serta aktivitas keprofesian lain mengacu kepada International Federation of Accountants dan Chartered Accountant Worldwide. IAI for Society dijalankan untuk memberikan manfaat yang semakin besar bagi masyarakat, serta untuk mendekatkan profesi kepada publik. Founding Fathers IAI telah menetapkan 2 tujuan pendirian IAI. IAI dibangun untuk mempertinggi mutu pendidikan akuntan dan meningkatkan kualitas pekerjaan akuntan Indonesia. IAI menguasai perubahan, menyiapkan masa depan. Ikatan Akuntan Indonesia, akuntan profesional unggul, Indonesia maju. Ikatan Akuntan Indonesia, IAI, telah berkiprah mendukung pembangunan SDM dan transformasi ekonomi Indonesia.
Akuntan memiliki peran penting dalam pembangunan nasional yang berkesinambungan.
Profesi akuntan mendukung upaya peningkatan profesionalisme SDM Indonesia agar bisa optimal berkarya mendukung pembangunan ekonomi yang efisien dan transparan. Melalui Prakarsa 6.1 yang telah ditetapkan sebagai program umum Dewan Pengurus Nasional IAI periode 2018-2022, IAI siap berkarya mengawal perekonomian bangsa ini menuju Indonesia Emas 2045.
Saya sangat mendukung rencana IAI untuk mempercepat program sertifikasi agar para akuntan di negara kita memiliki kreativitas, inovasi, keterampilan, dan memiliki daya saing, dan sekali lagi dalam rangka mendukung pengembangan ekosistem kita yang lebih akuntabel, lebih efisien, goal-oriented, dan inovatif.
Tanggung jawab itu terwujud melalui Chartered Accountant Indonesia sebagai identitas akuntan profesional Indonesia dan telah mendapat pengakuan kualitas secara global. Prakarsa 6.1 berisi 6 langkah aksi dengan satu tujuan strategis untuk memperkuat peran IAI dalam meningkatkan kepercayaan masyarakat terhadap entitas bisnis dan publik dengan menyiapkan akuntan profesional berintegritas siap menghadapi masa depan. IAI melaksanakan tugas dan tanggung jawabnya menyusun standar akuntansi keuangan dan standar profesi, melaksanakan ujian sertifikasi, serta aktivitas keprofesian lain mengacu kepada International Federation of Accountants dan Chartered Accountant Worldwide. IAI for Society dijalankan untuk memberikan manfaat yang semakin besar bagi masyarakat serta untuk mendekatkan profesi kepada publik.